Welcome back, everyone, and I'm so excited for today's episode with the one and only Ari Paul, the managing partner and CIO of BlockTower, and also an amazing fellow Miamian and friend and crypto winter warrior. Welcome to have you here.
Thank you, Felix, and thanks for the nice introduction. I think this is our second podcast together. We did one with one on Real Vision, so
yes,
really nice. I think you and I always have just super flowing, easy, fun conversations about crypto industry, markets, when we have dinner. So
yeah, exactly. And that's why I want to get you here too, because, for me, in a way, like you're kind of like my big brother in crypto, where I can always pass, questions by you when it comes to running a firm or trading and so forth. And also just such a treasure trove of wisdom in my eyes when it comes to really going at these markets with a very level head, because, crypto is very full of characters. A lot of people have very staunch opinions. Bitcoin is going to 100,000. Bitcoin is dropping to this price, where you are much more, I think, a realist, which I think is something we need, especially in times like this. So let me start with this. In a market starved for excitement, where right now everything seems doom and gloom, what's something that excites you?
Let's see. I've put this message out publicly a lot, and so people may have seen it, may be bored of it from me, although we haven't gone in much depth on this yet. So I'd say, real world lending, which I think may have even come up in our last podcast. I continue to be really excited about it. I think there's a lot of interesting activity within crypto on the theme, particularly in the MakerDAO community. Mm-hmm. So seeing the evolution of MakerDAO governance is actually, I have a young analyst who joined my team, and I said, if you deep dive into MakerDAO, you kind of have to learn almost everything about crypto in a little bit. Like it kind of touches on so many themes, from DeFi to stablecoins to DAOs to governance. And now kind of touching the real world, the regulatory, legal, and ops side, and now we're touching real world assets and how to value them, how to incorporate them into a crypto world from a composability perspective, a governance, all that. So super excited about it. Yeah.
So let's unpack that a little bit, because there's the real world in there. There's also lending, and I know recently lending in crypto has kind of gone on a fire with things like Celsius and so forth. Now, real world lending, the way you're looking at it, is fully decentralized, so it's on-chain, which would probably also solve some of these issues. How do you go about moving real world assets on-chain, and how's the custody of these assets being done?
All very hard questions. And I wouldn't say that using real world assets necessarily solves the problems we just saw from, say, BlockFi and Celsius, or at least not inherently. Mischief can be done with those. I think you could do exactly the same thing that kind of went wrong with those guys. I would actually say I think MakerDAO was kind of starting to head down that path of replicating what Celsius and Voyager got wrong, in the sense of having assets as collateral that are fundamentally very low quality, that are effectively mismarked, that are where you have a time mismatch. So you're locking assets up, you're getting paid for liquidity, but you have short-term deposits from retail customers who expect to be able to get those back on demand. So almost all of those problems were actually being replicated in MakerDAO. And I think MakerDAO is kind of course correcting now. So they kind of realized they were getting picked off. So what was happening was, you have this pile of money, and you have a community that is supposed to vote on how to allocate it. And that community are not credit experts. Yeah. And so I'm 38. I've been an investor my whole career. I have an MBA, CFA, all that stuff. And I hate credentialism, and I never mention that except to say, despite all of that, I very quickly realized I have no business evaluating a single credit deal. Basically, I was looking at the MakerDAO deals. I have no business, even with 100 hours, evaluating any of them, because I lack the skills. So what was happening was kind of predatory players were approaching the MakerDAO community and saying, finance my distressed Egyptian power plant at 6%. And the MakerDAO community was, in many cases, approving it, or at least seriously considering it, because they didn't know better.
They thought validation, real use cases are using us.
Yeah. And they just really had no understanding of the credit world. And that's not a criticism of the community. I mean, the point is, unless you're a professional credit underwriter, you have no business underwriting credit. Yes. It doesn't matter how smart you are. It doesn't matter how generally savvy you are in the investment world. It's kind of its own technical skill set, right, of how you assess cash flows, and it gets very complex and legal, because in credit, a big part of it is what happens in default. What legal rights do you have? How, what literally happens in a default, and generally, professional credit investors have a plan to, in some form, take possession of the asset. So that distressed Egyptian power plant you better have a plan to either operate it or you have a Rolodex of operators you can hire as third party. You have a plan at least.
Correct. Or somebody that will like acquire it if you need to liquidate it somehow.
Right.
Now that it's funny because like that would move us into another topic that I want to earmark for later with professional underwriting, because it also made me think of things like Nexus Mutual, where people are just staking tokens, technically underwriting insurance when that's a highly technical skill set. The same thing like underwriting credit, but we can tap into that later. Maybe give us so I guess the Egyptian power plant is a good example, because I was going to ask you what is an example of real world lending. Maybe you can give me 1 or 2 examples of what that looks like.
Sure. Let's see. So real world lending is kind of, I'm thinking of it as a subsector of real world assets.
Yep.
Kind of the nomenclature works reasonably well here. And so lending is, you're either tokenizing debt, so it could be tokenizing treasury bonds, corporate bonds, or more commonly what's being done is kind of lending vaults. So for example, Maple was operating a bunch of vaults, still are operating a bunch of vaults where borrowers like Orthogonal or BlockTower, for example, could borrow capital. So in a lot of cases, it's either it's primary issuance. So someone who has need for capital, either a trading firm or in the non-crypto version, it could be, for example, any consumer credit company, almost any company, like a small bank, for example, may want to borrow so they can make loans in Latin America. Or it could be, for example, so what we're seeing in practice is the time and effort to underwrite individual loans and individual borrowers is kind of prohibitive. And so the models that seem to be catching on to make that a little more scalable are, you have a credit underwriter operating a vault, and that underwriter could be a company. So for example, it could be a fintech 2.0 company that borrows money and then makes a lot of small loans that are, say, revenue-based liens to, say, tech companies, where you're just lending against their annual their monthly revenue from customers, no onboarding or recurring revenue. Or you're lending to funds doing the same. So that's kind of the dominant model right now that TrueFi and Maple are pursuing. I don't know how this ends up playing out. I'm not really pitching a single model. I hope we get competition, and people who say, oh, no, we don't want the intermediaries, we don't need the intermediaries, great. I have no objection to kind of a more direct model. The danger is just that unscrupulous players will post these borrowing proposals, and the community may not be properly equipped to assess them. So I think the way this plays out in practice is very similar to TradFi and just basically life, where you have trusted intermediaries who, in this case, you're not trusting them for custodial purposes or trusting with your crypto. You're trusting them as professional investors, and in this case, as professional credit investors. And so the idea is, I think a handful of players will establish brands as both investing acumen and also professionalism, trust, skill, all of that. And then those brands will be operating vaults, or they'll be different. I think there'll be different form factors by which they can offer products on platforms. But you'll be lending to those players either in the form of investing in their fund that is an on-chain, decentralized, fully transparent fund, or it can be like a credit line where you're getting a fixed percentage back.
What makes it more attractive for somebody in need of credit that would be credit worthy elsewhere to go through an on-chain vehicle? Because at current time it still feels like essentially the players it attracts are the players that wouldn't be credit worthy in other places. For example, crypto funds probably wouldn't get lent money by traditional banks. In most cases, maybe not Silvergate, but or as you said, the Egyptian power plant, right?
Totally, yeah. So I think we're solving a few different problems here. One, there's a few $1 billion in crypto that is kind of desperate for safe yield opportunities and doesn't know what to invest in. So it makes no sense, if you're a crypto native project and you just raise $10 million as, a Series A, and what do you do with that money?
Give it to 3 Hours Capital.
In practice, a lot did, yeah. Or they give it to Celsius or Voyager or BlockFi or whoever, and they're doing, they're getting whatever 3 or 5 or 8% back, and they really have no idea what's being done with their money and how it's being gambled with. So there is this demand where people don't want to leave the crypto ecosystem. They don't want to convert their USDT to USD in a bank. Maybe it's for AML KYC reasons. Maybe it's, whatever reasons people have. So one, I think we need to solve that problem and offer people high quality, basically the right products that that treasury should be in, which to me is probably a diversified, TradFi, boring basket of credit. It's not sexy, and it shouldn't be sexy, because you're talking about basically a high yield savings account. And a high yield savings account is not BlockFi, Celsius, Voyager, Genesis, or any of that. That's all crypto native, ultra risky stuff. Why take ultra risky crypto native exposure for an 8% return or a 10% return? If you're going to take crazy crypto native exposure, yeah, do it for the 5Xs, right?
Correct.
Do it for the reason, that everyone invests in crypto, which is not for a 10% yield. If you want a 10% yield, a lot of safer ways to get that in diversified form from TradFi.
Mm-hmm.
So one is we're trying to just take good TradFi products and offer them within DeFi in composable form. And by we, I mean, the industry, everyone
Yes.
who's working on this. That's solving a problem for a few $1 billion today. I think you ask a really important question, which is kind of how does this get from 0 to 1? So here's, I won't monologue too long in this, but basically there's the 10-year value proposition that I'm a big believer in, and none of that applies today. And the 10-year value proposition is very similar to tokenizing, say, equities, which is 24/7, unlike TradFi trading markets, which shut down on weekends and banking holidays and all that. Interoperability, so instead of having these segmented regional exchanges and prime brokers and all of this, you can seamlessly move the asset from one platform to another. Composability, so you can borrow against and yield farm your assets as a retail individual, which TradFi hedge funds can. They can if they're basically part of the prime brokerage system, but that's not even open to small hedge funds. You basically need to be like a medium-sized or big. And medium-sized means in TradFi like $1 billion. Basically, if you're not a $1 billion hedge fund, you can't get a direct ISDA with a prime broker, or it's very hard. And so you kind of you're not in that system. So over 10 years, and then cutting out middle and back office costs probably by 80%. None of that matters to most people today. So cutting back office costs from 20 basis points a year to 5 basis points a year, who cares about that, right? I mean, you care about if you're a pension with $100 billion of bonds, and 10 basis points matters in that case. But no one's going to try a brand new, crazy, risky platform to save 10 basis points, right? That it's similar to people who said, people are going to use Bitcoin to save 2% on a credit card payment. It's like no one's going to adopt crazy new technology to save 2%. There needs to be a much more powerful value proposition. There needs to be a 10x. So in a decade, I think this disrupts the prime brokerage system. It disrupts bond servicing. Another comical issue is there's constantly human errors in bond payment flows. So I was totally ignorant of this. As part of the research project I've been doing on this over the last year, we've talked to a lot of bond fund managers, muni bond funds, pensions, just like everyone in the credit world. And there's a weird pain point that I was unaware of, where constantly there's simple back office errors that happen, where a pension is owed $1 million in cash flows from a set of bonds, and they get $850K. And what's happening is there's like 8 separate companies that act as intermediaries doing different pieces of that. And literally what happens is one team will outsource it to, people in an office in India, Cambodia, whatever, where they're taking a PDF, typing it into a spreadsheet, emailing that spreadsheet to another company that then turns it into a PDF, that then emails it to someone else. They then manually type in the numbers. It's like this crazy Rube Goldberg manual process, which makes no sense. Now, obviously, crypto's not needed to fix that. That could all be fixed by a single, interoperable database. But TradFi isn't fixing it, and they haven't over 50 years. If anything, it kind of seems to be getting worse with just more of these intermediaries and players, and there's no pressure to fix it. So, eventually, big cost savings, better transparency, better composability, this is the future. But how do we get there? What's the value proposition over the next 3 years? So I think it's, one, we need to bootstrap this the way we bootstrap everything in crypto, with a little bit of kind of free money coming from effectively equity. So inflationary tokens, whether that's Bitcoin mining rewards, staking rewards, whatever, there's inflationary rewards where effectively you're getting paid in the equity of the thing. So inflationary rewards are definitely a small piece of this. Another piece that I think a lot of players are trying to bootstrap with is the cheap capital from players like MakerDAO to kind of finance this, to be able to compete head-to-head with, say, TradFi credit funds. And then the last piece, and I'm not sure about this, is there is an argument that investment-grade corporate bonds are serviced very well in TradFi. They get access. They're rated securities. You can borrow against them incredibly cheaply within the prime brokerage system. You can finance them cheaper than anyone in crypto should be willing to finance it. It's similar to home ownership. So basically, the U.S. government subsidizes mortgages. So I don't think crypto can compete on offering mortgages to normal American families, because the TradFi version is heavily subsidized, right? You can't make money offering a mortgage if you're not subsidized by the US government. So what are the niches that are underserved by that system? Basically high-yielding, non-fungible private debt. So for example, a doctor wants to build a Starbucks. They get a Starbucks license, they want to build a Starbucks, it's $1 million construction loan. That currently really generally can't get rated because the cost of rating a security makes it too burdensome to do for $1 million offering. And they're not fungible. So a firm like a BlackRock or a JP Morgan, they don't want their senior credit analysts spending a minute on this $1 million bond offering. They have to allocate billions of dollars. And so you try to do the math on that. If you have to underwrite loans 1 million at a time, and it's real work. So like I have a friend who 4-person team basically does those $1 million Starbucks type loans. I asked him, how many people would you need to hire to be able to deploy? If I give you $1 billion tomorrow to deploy over the course of a year, to basically doing what you do all day, which is sourcing these deals as a primary issuer, and then doing the diligence and then making the loan. And he said, well, I'd probably need to hire 100 people to be able to do $1 billion of $1 million loans over a year, because it's that time consuming, because we do site visits. We physically go to the Starbucks. We're prepared to take possession of it. We have our own contractors to finish construction if the doctor reneges on the deal. And that's what it means to be a professional credit underwriter and do this primary issuance. So the point is, those deals, because they're less scalable, because they're basically unattractive to a BlackRock to do, that's our 0 to 1 niche. That's our opportunity, where the firms like TrueFi, Maple, Centrifuge, Goldfinch, NLabs, all those guys are saying, we don't need to deploy $10 billion. We're not at that scale yet. So let's do a really good job on this underserved niche that the big boys kind of don't care about. That's our 0 to 1. We attract family offices, high net worth individuals to our platform who want to invest in this unusually attractive debt, basically. So if you're a high net worth individual on BlackRock, you don't get a look at this stuff because BlackRock doesn't offer it to you because they don't have it in their portfolio. So you'd have to go to these kind of small groups like my friend, but they're hard to find, they're hard to underwrite. If you're an individual, how do you, like I as an individual wouldn't even know where to start looking for those small teams to find, to allocate $5 million to debt like that. So it may be that we need to dangle a carrot of some really interesting corporate loans, and maybe that's under an ESG theme or a LATAM startup theme. There may be a little bit of a feel-good, sexy element of we're attracting people to invest in this theme or this region of the world or this cause, and then that is kind of our 0 to 1, and then we're bootstrapping, building network effects from there.
Right. And that actually kind of like guides us into that, the question I was earmarked. These platforms, they really are meant to be platforms where it's impossible for Maple or TrueFi to personally vet all the all the deals that come on, like people that want to get credit, or to underwrite them. So I think I talked to the TrueFi team a while ago, and they're creating like a whole portfolio manager system where kind of like the Lloyd's of London, where you can. So I can run a portfolio and select different credit, debts that I want to, underwrite, and people can invest into that vault, so to say. How do you find this balance between, open governance, anybody can participate, and still having, specialization, the right people in the right seats, because, going back to that example of like Next Mutual, not every staker is smart enough to underwrite insurance. Not every, I think TrueFi you can also get slashed. Not every, TrueFi staker is smart enough to, understand credit risk. So is this, how do we keep this, like, will this just be that the community of those platforms will be all the different people that already work in credit, or, how do you envision this?
I think you'll get a few different models, and I don't know which ones will be dominant. Probably a few should survive at serving different niches. So a platform that offers loan opportunities to very sophisticated family offices, for example, high net worth individuals, maybe they're just showing individual bonds or individual loan opportunities, and it's kind of caveat emptor. It's, you're very sophisticated. We assume you know what you're doing coming here, and if you don't know what you're doing, it's probably not it probably won't look like a good platform for you, because there's going to be like pages of legal docs and for your review, and it won't be, ideally those platforms shouldn't be geared towards retail. They shouldn't look like they're trying to attract retail deposits. They should look like they're for professionals. And then I think you have kind of a middle ground where it's kind of branded funds. That's how most of the fund management industry works today, where, for example, someone says, okay, I go to Fidelity, I look at their fund offerings, I can kind of assume that anything in the Fidelity list is at least not a scam, right? But whether it's invested well is a separate question. Whether it's a smart investment, whether the manager's great, but it's at least trustworthy, right?
Yep.
Probably.
It's vetted enough.
It's somewhat vetted.
Yeah.
So, and then and then managers fight to brand themselves, so kind of like the mutual fund world, right? Where someone like a Bill Miller builds a track record over 15 years and writes thought leadership essays and tries, convinces people that he's a brilliant investor, and then more money flows to him through whatever platform he's on. I think that's a pretty reasonable model. I'm not saying it's perfect or anything, but that's kind of how the world generally works. We have trusted intermediaries who build brands over time. When it's done well, when basically, ideally, the brand matches reality, and people with great track records who are operating professionally are well regarded, and those who aren't are not. The world doesn't always work that way, but I think that's kind of as good as we can do.
Right.
And then the far retail version, probably I would still say that I would caution retail about that, because I'd say the whole mutual fund industry, for example, was basically a shell game conning retail using that psychology. So like for those who don't know, basically the way the mutual fund industry used to work, there's now regulation against this, is every year they would launch basically 1,000 funds. You'd have one manager running 20 different funds at a random mutual fund company. And then a year later, the 10 that underperformed were shut down. Another 10 were launched. And so at the end of 5 years, you're guaranteed to have 20 funds with a stellar 5-year track record. And then you market the hell out of those. So very simple cherry picking and survivorship bias, kind of weaponized against retail. There's now regulation that makes that a lot harder for mutual fund companies to do. But that kind of thing still happens en masse on Wall Street. So the most retail version would be, there's a single trusted brand, that's the platform. You're trusting the platform, and the platform is kind of doing all of this work for you. I think that's going to happen, and eventually it'll happen successfully. The fear is that we just saw how wrong that went with Celsius, Voyager, and BlockFi. Yeah. All three presented to their customers that basically they were savvy investment professionals with professional risk management, and all three had no idea what they were doing as investors. And I'll say that, I'm not saying that they were bad people, I'm not saying they're not smart people, but in some cases they were smart as tech entrepreneurs, and maybe smart on the technology and smart on the entrepreneurship,
right.
But basically financially illiterate when it came to actual investing, trading, portfolio management.
Right.
That doesn't have to stay the same, right? Like BlockFi has been hiring, TradFi credit analysts, for example. So I hope that firms like this level up their expertise and optimize for security, for the safety of those deposits. There's also a perverse incentive principal agent problem. If you're a BlockFi or Voyager and you're raising VC dollars, you're being pushed very hard to maximize deposits. And the way you do that is by offering the highest yields, higher than your competitors. And the way you do that is by gambling like crazy and risking ruin with your customer deposits. And so basically, if you as the platform are going to take on this responsibility of being the fiduciaries, you better do it like a bank. You better do it in a responsible way where you're not going to lose your depositors' money.
And so I think we're approaching an interesting time, because like initially, I used to believe that everything needs to be decentralized, the future's decentralized. And I still believe that the ground layer, the infrastructure, is what needs to be decentralized. But on top of it, in order for society to function, in order for like a lot of these services to properly function, like you do need trusted third parties to some degree. Like underwriters, for example, they say like, hey, I myself am not smart enough when it comes to credit, so I don't know which ones to pick. But there are people with track record that can back. Now that being said, I think the one part that blockchain, like what something even with real world lending and DeFi brings to the table, is an added layer of transparency. So for example, like if we had known what exactly Celsius does with a book, if we knew what BlockTower was doing with a book, like look, if you play GBTC and I understand GBTC and you tell me that you do GB, great. Then like I know what risks I'm signing up for, or that every single one of the ETH is in staked ETH, and I know there's not enough liquidity, great. But a lot of this stuff happened behind closed doors. So do you think, would something like, Maple even, or TrueFi, doesn't matter the player, enable there to be more, I guess, transparency with, organizations like that? I guess one last caveat is because, to some degree, you want privacy, like as an institution, because like let's say in the hedge fund world, for example, like I don't want to publicly display my book 24/7. So for example, we backed Enzyme, which does that, but at the same time, I'm like, do I want everybody to know my short position? Probably not. So where is that middle ground?
So first on the privacy point, something that Zuko Wilcox's eCash always emphasizes, and I think just does so articulately, is privacy doesn't mean opacity. It means choice. So our medical records legally have to be private and legally have to be shared with the government. And currently that's done in insecure form from an IT sense, because often those records are badly or not at all encrypted. But my point is that in an ideal world, your medical data is perfectly encrypted using ZK snarks or whatever is best in practice. And it's trivial. It's super easy for you to reveal that to your medical provider, to anyone who legally has to see it, but no one else can see it, right? No one can see it without your permission or whatever entity is in question. So privacy is always a win in my book, and then we can decide who should, selective disclosure, who needs to see this, who should see it. But I'm all for everything being default private, and then ideally things are selectively disclosed. And ZK proofs enable some really cool stuff where, for example, a platform can prove its solvency without having to divulge any specifics. And the math works. To my knowledge, there's not a single platform utilizing that kind of math in any kind of holistic sense. But I think we'll get to a point where, for example, a platform like a Voyager, BlockFi, Celsius, or whatever can kind of basically prove their deposits and their loans outstanding and that things are in repayment without having to necessarily reveal the identity of every borrower.
And that's interesting and pertinent to right now, because the whole situation with Three Arrows, from what I've gathered, was that none of the lenders wanted to talk to another, that they had this big client that was giving them all this business, so nobody talked with one another. And pretty much, Three Arrows had, let's say, a certain sum of capital, went to lender one, said, hey, we have this amount of capital, can you lend us some money? They lend the money. Now they go to lender two, and now if they got their original money and the lender's money, hey, can you lend us some money? And so if this is done on chain, with privacy, for example, like you could, none of the counterparties could know of each other, but you could perhaps see how much debt has this player already acquired.
Yeah, this doesn't, crypto doesn't perfectly solve this, but I think like with some social pressure it can help. So here's why crypto doesn't perfectly solve it. So if I have a set of assets and I borrow against those assets in DeFi, let's say on Aave, I can then still go to a TradFi bank, let's say, and borrow, and then I can borrow. Here's the problem. I'd frame it this way: you need a limited search space. So the problem with someone borrowing from multiple counterparties against the same collateral, the only way to solve that is if everyone agrees there's a set of people who have all the information. And that there's no way to enforce that really in practice, in the sense that like maybe I make that promise to my bank that I haven't loaned my capital to anywhere else, but I go to the neighborhood loan shark and I loan it,
Sure.
And so it doesn't perfectly solve it. In the this is a problem in the TradFi system extensively. We saw this with Archegos. Archegos just did basically what 3 Arrows did to Genesis. Archegos just did to Credit Suisse, where they had a set of collateral and they borrowed from multiple prime brokers, and the prime brokers weren't talking, which is crazy to me, by the way, from a regulatory perspective. It's bizarre that regulators haven't basically forced the prime brokers to be kind of sharing that information in some form. I'm actually curious, frankly, why they didn't, because generally that aligns with my mental model of who regulators protect, which is they protect the prime brokers. Yeah. Basically, there's just a, I think it was this SEC. Was it the SEC? Maybe no. It was multiple regulators just fined banks like $1 billion for using Signal and WhatsApp on personal devices and not recording that at the firm level. And it was an unusually large fine. And the public coverage, like Wall Street Journal said, like, look at this unusually large fine. Basically, when banks rip off customers, they get a $10 million fine. When they hide communications from regulators, they get a $1 billion fine. Why? Because that's taking power away from regulators.
Sure.
Screw your customers, small fine. Take power away from the regulators, big fine. So I'm kind of surprised, because protecting the prime brokers from the likes of Archegos is kind of a primary role of the regulators, as, at least how it plays out. So I'm surprised that hasn't been implemented. But basically what you'll be able to say with confidence is this collateral that's pledged in the DeFi ecosystem, it's completely transparent what recourse there is against that collateral. So like Celsius, was just repaying their loans on Aave because they had to, because they were over-collateralized loans, and to get the collateral back, and anyone's able to look at the smart contract and see exactly how that works. So I think we'll head into a world eventually where everyone is checking all of these public sources, and the private sources are kind of, at least the biggest private sources are integrated into that and are talking to each other. But yeah, that won't perfectly solve it. But you, outside of that system, don't have to be a lender. Like, you never have to be hurt by anyone's malfeasance on this. You can just say, I'm only lending to you through an Aave-like platform where you have to post more than 100% collateral, for example. The players who got hurt here were the ones who got hurt out of greed, right? They had capital, they wanted to earn incremental yield. They could have said, we're only lending to you in collateralized form 3 Arrows, but that wasn't good enough, right? They wanted to, 3 Arrows, I'm sure, said, hey, we want to borrow a marginal $300 million at 8%. That's 2% more than anyone else is going to give you. And you have to do it uncollateralized. And greed, so basically greed's always going to exist, and people are always going to be able to choose to make bad decisions like that. Crypto won't fix that.
So, until it is fixed, and I know on the VC side, you back a lot of prop tech. I think we talked about this before. What can depositors and investors do to kind of make sure that they don't fall for the next, Celsius, BlockFi, Voyager, and so forth? I mean, for me, I always say, ask where the yield comes from. I think that's a great place to start. But where do you see the differences, whether it's operationally, leadership-wise, and so forth?
I'll give my general answer and then my specific one. My general answer will have everyone's eyes rolling because it doesn't feel that helpful, but it's my genuine. I think this is actually what everything comes down to, which is, in crypto, in bull markets at least, money feels free, and it feels like tokens, right? It feels like playthings. It feels people have millions of dollars in tokens or NFTs or whatever. It doesn't feel like real money. They don't treat it like real money. So step one is treat it like real money. If you're putting it out there, if you're lending it, be serious about that. Have you researched who you're lending, a meaningful chunk of money to? And kind of just first principles, common sense, like what does it mean to lend money and hope you get it back? What is that money being used for? What is the financial health of the entity borrowing it? Have you looked at, I'll say this for myself. I almost can't imagine ever lending money other than in a friendly context, right? Where I've lent money to personal friends without asking for a balance sheet, of course. But, if I'm lending to a company or an arm's length individual in a commercial context, I want to see financial statements. I want to see cash flows. I want to see, if I'm lending it to a trading firm, you got to walk me through basically exactly what you're doing. And what ends up happening is the borrowers say no, and 3 Arrows says no, and then what do? Well, my answer is I just don't loan. I forego the yield. So I can tell you, for I and BlockTower, we left a lot of money on the table in DeFi summer and since. We mostly don't lend our assets out, and that's cost us, right? There were people who were making 10% on their capital when we were sitting on it doing nothing. Yeah. You have to be willing to do that. You have to be willing to say, if no one is going to give me the proper information for me to be confident that something's a good trade, a good investment. It's kind of like if an entrepreneur comes to you and says, I'm not going to give you any information because I have people who are willing to write me $1 million check without it. That happens, right?
Yeah,
it happens in bull markets where entrepreneurs, every VC is banging on their door. It's some sexy theme. They have a good reputation.
You'll have 24 hours to write me a check.
Right. And you're lucky that I'm even giving you the wire information, right? The answer is you don't invest, and you might miss the next Facebook. But if you're worrying about missing the next Facebook, you're going to end up losing your money to UST or Celsius so that's number one. So okay, but now let me give a few specifics. The model of BlockFi, Celsius, and Voyager was never valid. It's a money-losing business model. It never made sense at all as a business model. So I would start by saying yield is not I'd go this far. The concept of yield is almost broken in crypto. When people say yield in crypto, what do they mean? Well, either it's like DeFi yields, which typically came from inflationary tokens, which weren't yield. For anyone here who's a derivative trader, it's kind of the equivalent of saying, this is not the best example because not that many of your listeners are kind of fluent in options, but basically unsophisticated people will say something like, I just sell a put on the S&P 500 or on Bitcoin every month and I collect yield. And you're not actually collecting yield. So yes, you're receiving cash flows for selling that put every month, but if the put is priced fairly, you're not making or losing money. Right, so it's kind of like saying, actually,
ultimately you are the yield, and because it's a negative skew where 1 out of 10 times, 9 out of 10 times you make money, but then the 1/10th time comes and you might give back way more than that, which is kind of similar with the rates they were paying. If you're getting 9% on your stables, do you think there's a chance that 1 out of 11 years you're going to lose money on this platform? If yes, then it's a horrible risk reward scenario.
Yes, but going even further, where is the yield actually coming from? And I mean this in the deepest kind of conceptual sense. So yield in the real world, in TradFi, and in frankly just life, is you have something productive happening. So I'm a bank, I lend money to a business that is building a factory. The factory, if things go reasonably well, increases production, they sell more chairs, there's more cash flow coming in, they pay back the loan with interest. Everyone wins, right? Everyone is richer as a result of that because the cash that I lent financed investment or productive activity that increased production, that increased cash flow. Everyone won. There didn't need to be a loser in that kind of set of transactions. The problem in crypto is there's almost no actual source of productivity for these things. And so if I lend my Bitcoin to someone, what can they do with it that creates more Bitcoin or more dollars? There aren't many answers. So you could say, well, it could be a Bitcoin miner who's going to build mining facilities. And that's true. And that could be the case. But worth noting that Bitcoin mining is fundamentally zero sum. That if there's $100 billion poured into Bitcoin mining, on average, that can't produce more wealth for the world. Not directly, at least, right? In a first, because they're all those
Still
miners
the same
are
amount of Bitcoin.
competing. They're competing for the same inflationary rewards. You could argue that could help push the price of Bitcoin up, and so there may be second order effects. But so really, the only source of demand to borrow crypto was by speculators, by traders. So market making shops. People like 3 Arrows who are doing, levered spread trades or DeFi yield farming or whatever. And if you think about it, so it's literally the only reason that anyone was borrowing crypto, some slight exceptions to this, but tiny, was really they were market makers in the casinos or they were speculators in casinos. And both of those are zero sum, right? Ultimately, I mean, during a raging bull market, everyone can be making money because there's new money coming in. But at the end of the day, those are zero sum. So the fundamental problem here is everyone was hungry for yield in crypto, and there was basically no real yield in crypto. That even the things that there's nothing wrong. So like, let's take ETH staking, right? Nothing wrong there. Transparent, open source. I'm not criticizing it at all. But it's not like wealth is being created, right? So what's happening is at the margin, there's more ETH being created to reward stakers, and that devalues all ETH. And that can be part of a healthy, productive, secure ecosystem. Or it can so that idea can absolutely make sense as a way of securing the system potentially, and therefore help ETH have a lot of value. But the point is, it's not yield. It's moving money around to incentivize offering security or something like that. So here's the reality. Anyone telling you they're going to give you yield on USD or on crypto within the crypto industry, it's probably a broken business model or a Ponzi, not necessarily a scam, but an accidental Ponzi where it just, you're forced to do what these lenders did and basically gamble with deposits. And my objection to that at its most basic is, because like Felix, you and I kind of do that professionally. We take capital from other people and I'd like to think, I wouldn't use the word gamble, but we're gambling with it, right? We're doing it in an educated way. We're doing it in a risk-managed way. We're doing it in a way where certainly we hope we win more than we lose, and we have historically. But the key difference is, one, I hope we're both transparent with people, giving us capital to do that. Very transparent about the risk we're taking, the fact that they could lose all of their, every dollar they're giving us, we could lose, and I try to walk people through how. And they're sharing in the upside. Right? So if they're taking a risk of total loss, but they could get a 2x or 5x or 10x on their money.
We're not capping it at 7%.
We're not capping it at 7%. If someone said, Ari, I want to invest with BlockTower or with Felix, and I take the full risk of your strategies, but the most I can get is 7%, I'd say run. That's a horrible product. Yeah. Horrible. It's insane. And then someone might push back and say, but there's a lot of credit, TradFi credit products where they do have capped upside. Yeah, and that's when the risks being taken in those funds are so comically trivial. So I think one thing that crypto people didn't get, I had some pushback even after Celsius blew up. I had like some Celsius shills kind of debating me on Twitter, and someone was saying like, Ari, like, what are you talking about that this was unsustainable or Ponzious or not valid? Isn't this what like banks do? It's lending. There's a huge difference between professional lending, where you're lending against, you're lending to Microsoft against revenue, and you're doing extremely detailed analysis even there. Even lending against Microsoft, where you're looking at their balance sheets and financial statements in detail. You're doing channel checking, diligence. You're making sure that you're checking legal filings to make sure the assets aren't encumbered. All of that versus what we've seen, where with
It's
3
like,
arrows,
right? We just saw it today. It's like, what's your NAV? We have 2,300 in millions signed. Kyle Davis.
Yeah, it's the difference between shooting a bullet and throwing it. Like it's conceptually in the same direction. They're both lending, but it's so night and day. And basically, if you're not confident that you can tell the difference, which is very reasonable, by the way. I'm not trying to insult people who aren't credit experts. I'm not, I know I've spent a lot of years studying credit, and I'm still not a credit expert. So obviously, I don't expect the average doctor to be a credit expert. Point is, if you can't tell the difference easily between those two, if anything I just said sounds at all confusing, then don't take the risk.
Right.
You don't have to invest in every. There's a million niches and sectors and industries I don't invest in because I have no idea what I'm doing.
And the perverse thing is that people kind of they think things are conservative if the offering looks conservative, right? So for example, if there is 100,000% APY on Olympus, they're like, well, this is a Ponzi, right? But when they say, hey, we're only paying you 7%, then could be fair, must be fair, right? But even then you need to ask, like I had in another podcast with Chilang from Ledger Prime where we talked about, for example, like BlockFi early days, like 6% on Bitcoin. Who pays you 6%, right? It's as simple as that. Let's rotate into something else. I remember we sat together at dinner one time and we kind of discussed our approaches, value versus momentum. And I know you lean more heavily on the side of momentum, where you said some rough quote. When it comes to value investing in crypto, it's not like Warren Buffett will buy your, Aave tokens because their PE ratio is low. Now, you do seem to see value in real world lending, but, kind of walk us through your overall perspective of the crypto markets. Like, how do you, momentum versus value? And with momentum, how do you play? Because I know there's a whole, we can get into musical chairs in a little bit, but let's start with that.
Yeah, so the problem with value in crypto is that almost everything is close to entirely circular. So I'll use an example of a project that, disclosure, I'm currently long it, not in huge size, but I'm long it, and that I like fundamentally, and I'm happy to hold up to anyone who's criticizing the crypto industry, and that's Uniswap. So Uniswap is, I think of as one of the most fundamental value-oriented crypto assets, in the sense that very simple model, not at all Ponzi-ish, in the sense that it's a DEX, people get value for using it. I mean, a very clean history, the way they did an airdrop and non-ICO, all of that. But not even talking about that, just clear product that people derive value from, clear cash, basically potential cash flows, right? Clear reason the token could have value, which is very equity-like in theory, that at some point token holders could vote themselves the exchange fees being paid. So you can value it like equity, in the sense, you can look at basically those potential cash flows. The problem is that the only thing Uniswap is used for is speculation on cryptocurrencies. And so as we've seen, in the last 6 months, TVL's exchange volumes, everything has plummeted. And it, call it down, let's say 70 to 80%. Exchange volumes, TVLs generally. There's nothing that prevents that from falling 90% again. So as an example, actually, I was chatting with an analyst today who said something like, actually, I'll name the project. We were talking about STEPN, the move to earn game that had a pretty fantastic valuation recently, and is still trading a pretty high valuation.
Still about $5 billion.
And he actually asked, it was a very similar, he asked me something like, is there a price where you would call this value? And my answer was kind of like, there is one. I'd have to do some work. I don't have one off the top of my head. I would have to do more work in it fundamentally, looking at things like daily usage and the financial statements and all of that. But the problem is kind of what we saw with Axie Infinity. It's not, people throw out, well, maybe this thing won't keep growing parabolically. So a conservative assumption is that growth dies and it just maintains current usage and revenue. That's what people were saying 6 months ago about Axie Infinity. That's what people were saying about Coinbase when it went public. And the reality is that's not conservative. Conservative is it falls 99% fundamentally. The usage falls 90. And that's, I don't know the exact numbers on Axie, but I believe usage numbers are down more than 95%.
I mean, I think they peaked in the millions of users, and they're down to like 9,000 daily active users. The NFT volumes went from 360 million in August of last year to last month, June, they made $200,000. So revenues in the gutter, user numbers in the gutter.
So that's the problem with value, right? If anyone who threw out a value number for Axie Infinity 6 months ago would have done it based on current or recent past fundamentals, usage, revenue numbers, all of that. And then even if they thought they were being conservative, they might have said, well, let's say this falls by half or 75%. And that still wasn't anywhere near conservative enough. And really what we're saying here is that there's very little predictability to usage and cash flows of these crypto products and assets. Very little stickiness of the user base, that very often the fundamentals are being massively pumped, artificially pumped by incentives.
Yep.
And so without those incentives, things often fall 100% in terms of usage, or extremely close, 99.5%. And so how do you think about value in that light? Well, I think you still can. So at some price point, you say, well, even if every user left, is there still value in the tech they built, the brand, the team, that kind of thing? So, even if we had the deepest imaginable crypto bear winner, if the Uniswap team was still hard at work, still head in the game, still focused, I'd say there's some value to that team and that property and that brand. It's a low value, though. It's not,
it's not 10 billion.
No, it's probably, it might be 20 million or something. If we're talking about a Uniswap with no users, to be clear, I'm going to have a bunch of people saying Ari says Uniswap's $20 million. No, just to be clear, I'm talking about a scenario where Uniswap has basically 0 users.
Yes,
that there's still, I would still pay for Uniswap even in that state, but, it's just a very low number.
Got you. Okay. Yeah. No. I'm very much on the same page with you. Some of the names you mentioned, we're actively shorting, because the funny thing with STEPN too is that the people paid a lot of money to get these shoes. They walk. They get GST, and they there's some sinks in there. Like for example, like you can upgrade your shoes with GST, but like the more the GST token falls, the more they need. So now there's users complaining. Well, when I first signed up, it might have taken me, let's say, 3 months to make my money back. Now it's going to take me 50 years. Those exaggerations. But the point is what I've noticed in crypto, there's a lot of flywheels. And the flywheels that make things go up in the bull market, the same mechanisms, is what tears them down in bear market. Same thing, Luna's whole mechanism is what drove it from 20 cents to $100 and then right back down to 0. So understanding that value is very, on one hand, reflexive, and also value can be kind of like a lagging indicator that's kind of drawn by incentives where, yes, today, let's say Axie, as of August 2021, was a high, incredible value investment, 2 PE ratio, whatnot, right? But short time frame. You seem to be really into momentum. So how do you think about momentum, especially when crypto, let's just take a look at, for example, layer ones. Layer ones last year, I think, were a great example of that, where we had a little bit of musical chairs where January 2021, Binance Smart Chain, April, Polygon, late summer, Solana, Luna, and the show goes on. So how do you identify momentum, and when is the right time to leave?
It's funny. My by nature, I'm much more of a value investor. When I was getting into crypto, professionally, it was obvious these are momentum assets, and I yelled at myself you can't try to be Warren Buffett here. That's gonna end in tears. A lot. I would go this far. I think most investors, including some very smart people who try to approach crypto fundamentally in a true fundamental sense, have been very disappointed. Yep. The best tech usually doesn't win. And frankly, I don't think this is that different from tech investing generally, which is that, what do we mean by fundamentals even? Actually, as a fun anecdote, there was I forget the name of it. I was friends with a couple entrepreneurs, very young guys in 2017, who built a dashboard to screen all cryptocurrencies according to 400 fundamental variables. Mm-hmm. It was early for its time. They were very smart guys. And then I ended up hiring one of them a couple years later, and he basically hadn't looked at his dashboard in 3 years, and we compared it. And the correlation was 0. It was 0 between the fundamentals they had identified with these 300 variables that were pretty smartly done. They tried to, everything you could think of, they tried to incorporate, and just basically 0 correlation. Part of that is because it's what do we mean by fundamentals, right? So someone might say, well, fundamental means the quality of the coding, right? Someone else might say, why does that matter? The fact that Bitcoin was originally coded very sloppily, so Satoshi wasn't a great coder, and the code was kind of poorly written. It worked well enough. The fact that it was poorly written didn't end up mattering that much. It worked, and it had some critical bugs. They got patched. So it can be a case of looking for the wrong fundamentals, and then it's also, unless you're looking at a 5+ year time frame, those flywheels you mentioned mean that in any given year, it's the flywheels that are driving things. So there's some investments that I'll make with a 5+ year time frame, and on the VC side, I sometimes write checks where I'm like, I truly don't care about this over the next, this is a 10-year bet kind of thing.
Yeah.
But unless you're doing that, unless you're being honest with yourself that this is a 10-year bet and you don't care what happens in the middle, you have to care about the flywheels. You have to the noise from the trading, the noise from the speculation is so much more powerful than the signal from the fundamentals, right? We routinely see mid-cap assets 30x and then fall 98%, right? That happens every couple of years. And so let's say the signal from the fundamentals in that was a 3x. Well, that's getting completely overwhelmed by the trading noise. It'd be the equivalent of like if Microsoft stock was swinging like 20% every day for just idiosyncratic noisy reasons. It would almost be stupid to try to like predict the next earnings release, because okay, if you're right on the earnings release and that produces a 10% rally, that's just lost in the noise, right? So if you're a trader in crypto, if you're optimizing over like a quarterly or annual time frame, I think you have to be not necessarily a momentum trader, but at least more of a trader in that sense. And so what I mean when I say that I do a lot of momentum trading, I don't really mean it in a these terms can mean a lot of things in different contexts.
Right.
Like in TradFi equity, like Cliff Asness, if he says value momentum, he means quant factors. He means formal risk premia that are like statistical factors. Usually if traders are talking, they mean more like, are you playing for breakouts? Are you playing, ranges of mean reversion kind of thing? I mean it almost meta to that. I mean it more like trying to understand. I'm usually betting on one of two things. I'd say these are the things I've historically been best at betting at. I bet on a lot of other things too, but I'd say these are kind of the things I've shown some skill at, which is one, betting on trends of cash flows. So for example, in 2020, the marginal dollar coming into crypto were high net worth billionaires, basically. It was Western Hemisphere billionaires, people like Michael Saylor, who then convinced Elon Musk and Tesla to buy at the end of 2020. Paul Tudor Jones. And they were buying mostly Bitcoin, and they were buying on basically 3 exchanges during US business hours. And basically, when we saw that happening, we kind of said, this is going to be a 6-month trend. These cash flows are going to be coming in, and we don't need to wait to see the trend on the price chart. We can buy the momentum basically the first day we see the cash flows. And it's still a momentum bet, even though Bitcoin might be sitting at its lows, even though there's no actual momentum on the chart yet. We're betting on the momentum of the order flow, basically. And then thematic momentum, so betting on, the crypto world is getting excited about DeFi, and VCs and institutions are all getting excited about DeFi. That's probably going to produce some positive flywheels, and that's probably going to be a 1 to 2 year kind of trend. And basically, we want to buy in aggressively. We want to be playing this from the long side in every way, and then at some point when it starts feeling bubblish, you start looking for a way out.
Oh, so are you saying like because I know DeFi's been in perhaps the longest winter. DeFi started the winter like a year early. It sounds like between real world lending and Uniswap, you are mostly bullish on DeFi compared to other segments, because I remember you did say that things were overheated in like metaverse and whatnot.
Yeah, let's see. So 3 months ago, I would have said, I kind of don't want to look at DeFi. It's not done with its bearer yet. And the stuff that was sexy in Q4, I should have been aggressively shorting. I didn't. I just said like this stuff's toxic. Let's not touch it for a year. Basically, when a bubble bursts, you usually don't want to look at it for a pretty long time, longer than you think. And I was pretty confident the Q4 sexy themes like metaverse were just like very classic end of bull cycle bubble, where unlike with DeFi, so in my mind at least, DeFi summer started with something real, then you added the inflationary incentives, the flywheels, and then by like middle of last year, we had kind of the DeFi 2.0 stuff that were small incremental improvements, people raising it. It was like, hey, we're going to fork this Ethereum thing onto AVAX, give us 100 million valuation, and people did. And so you had this like incredible inflation in projects, right, sucking up VC dollars, everyone kind of trying to do their own inflationary rewards. But you had something more fundamentally substantive there in the unis and aves and compounds earlier, and it was a little bit more of a kind of drawn out. Whereas the meta stuff, to me, I was pretty confident it was going to be a short-lived bubble and would just die hard because there's so little of substance there, from my view. Stuff like crypto voxels and sandbox is so far from having product market fit to me
100%.
that I'm not saying they're bad projects or bad teams or anything. It's just I look at them and I'm like, I don't even see a path to this having 20,000 daily active users who are not paid to use it. So yes, that was kind of my pessimism. Whereas something like Uniswap, I thought, okay, this can crash, but at some point in the next year, this is an obvious value. This is something where people will look to buy value because there's a proven sustainable value proposition there. There's some degree of proven product market fit, even if that was 10x inflated or 20x inflated. There's still a somewhat healthy kind of kernel here that means that, you know, at a few $100 million valuation, there should be value buyers, and it should be hard to sustain, you know, much below that for long. Obviously, that would be, I don't know where Uniswap's trading right now, but that would be pretty far lower than here. I'm not trying to like suggest a price, but I actually don't have much of an opinion on DeFi here. The DeFi 2.0 stuff, I probably still wouldn't touch for a long time. Anything at that bounce is probably a dead cat bounce, but the stuff like Uni and Aave, maybe the bottom's in. We have small positions in both. It's not a super aggressive bet. It's not a thematic bet. Frankly, there's kind of small bets. I wouldn't. It's not super high conviction. And I say that those are great projects. I mean that more in a trading sense. You know, is this the right time to buy, the right price to buy? I kind of have no idea. But I do think they're fundamentally sound buys, you know, for the next 2-3 years. The real world lending thing, I have no sense of timing. I'm not shilling people that these assets are going to, you know, 3x their money in the next 3 months or anything. In my head, these are, this theme is a 10-year bet for me, truly. Yep. And I like truly. Everything I'm doing, everything BlockTower is doing on this theme is optimizing over a 10-year horizon, which sounds absurd, right? All of crypto is barely. But it's even showing up in our concrete decision making where like we see opportunities to be predatory with some of these protocols in the way I kind of described people were doing. And aside from the ethical side, we're not even thinking about it from the commercial side, which is basically the way we optimize over the next decade is by building a reputation of being really, really friendly partners to these protocols. Yep. Who, you know, we're the furthest thing. Not only are we not going to pick you off, we're going to like open source everything we're doing, and we're going to tell you our exact profit margins. Like we go to MakerDAO and we say, please make us a loan at this rate. We're going to tell you what the fair rate would be, and we're going to say, yes, we want you to loan us at 1.5% below market. You know, we got to make money too, kind of thing. So we hope to go above and beyond, and that's going to cost us, right? Our less scrupulous or less friendly colleagues will make that same proposal to MakerDAO and mislead them a little bit and get a cheaper cost than us. But so yeah, very long-term theme. On the assets themselves, I'm certainly hoping they work faster than that. The reality is that I have no idea if any of these protocols will exist in 10 years. I have no idea if Maple or Centrifuge or TrueFi or anything. I mean, 10 years is a lifetime in this industry. Crypto. So, you know, we have a basket of real-world lending assets that, frankly, is most of the credible ones. And I'd say I'm pretty confident that's going to be a, you know, attractive basket over the next 2-3 years. I think if crypto is sideways, it's one of the very few growth areas that I see in crypto. It's one of the very few kind of fundamental growth areas over the next 2 years. There's some others, but not that many. There aren't that many things I'm excited about fundamental growth in over the next year in crypto.
Because even in pockets like DWeb, like let's say ARWeave and Helium and so forth, while they are seeing growth, I mean, their ratios of price versus earning it's just wildly off. I think, you know, ARWeave is like 5,000 or something like that, and even of the millions of ARWeave tokens that exist, I think only 30,000 are staked. So there's a very little usage compared to where they are valued at right now. Whereas with real world lending, if Maple and so forth are already down to like let's say $60-100 million market caps, you know, we may be closer to a floor than a lot of assets.
Yeah, I think, and the math is pretty attractive, which is I'm pretty confident we're going to, basically, if nothing goes wrong, I think there's a few $1 billion in TVL on this theme in 12 to 24 months. Maybe it takes a little longer than that, but basically you just need a few players like us. Basically, if I've done my homework correctly and the value proposition is there that I think there is, it only takes a few players like us to productize that and bring billions of dollars in, and then, you know, pretty confident that if a Centrifuge is $1 billion TVL, that the market cap will probably be at least a sizable fraction of that. I think for good reason too. I would argue that that's a fundamentally sound valuation. I don't think I certainly hope that I get the chance to exit into a bubble on this theme. Frankly, look, hey, I'm a trader. I'm gonna, you know, I'll be real, but I'm not counting on it. You know, I think I'm hoping for 10x's on this theme over the next 2 years without any appreciation in multiple. Like, so you'd use a TradFi analogy. You have like what are the cash flows for this company, and then what multiple is the market giving those cash flows. Obviously, I'm hoping that in a bull market you get the multiple expansion, but that's really not the bet. The bet is that the fundamentals will 10x over the next 2 years.
Nice. Fundamentals from Ari. Let me ask you this. How do you view chain dominance? I know like last year, layer ones were a huge topic, from, again, we mentioned a lot of this, Solana, rest in peace, Luna, Polygon. We've got roll-ups coming up. I don't know how deep you are into, scaling solutions and also layer ones. How do you view it? Do you think ETH will get disrupted, or is it now with the merge coming up, everything's going back to ETH? What's your take?
I don't think everything, okay, so first, I think Solana's positioned pretty well. So disclosure, we're long ETH and Solana. But actually I'm not really talking my book here. Like, our Solana position is not big enough for me to be shilling it, frankly. I think the changes the team is making now and has been started making a few months ago to basically fix the protocol so it wouldn't keep going down are very likely to succeed. I say that as a non-technical guy who isn't ultra in the weeds on the tech. But basically, the whole chain kept halting for pretty simple reasons. One of those reasons was a fundamental design flaw, which is that the Solana team was so adamant around this idea of infinite bandwidth that they didn't have an auction market for block space, which inevitably broke the chain. Like, that was obvious from day one, should have been obvious. I'm not trying to beat up on the team. Everyone has blind spots, and the team has executed quite well, I think, overall. But that was obvious, something that was going to have to change at some point, and so the network started getting congested, and they were a little bit slow to realize kind of what they needed to do to fix it, but they're fixing it. And then there's some other kind of like relatively minor engineering glitches they had to work out on the communication layer and the way data's stored. But it's all fixable, and it seems like they're fixing all of it. And so I'm somewhat optimistic that in another 3 to 6 months, Solana will be a stable chain. It sounds a little bit funny saying that about a multi-billion-dollar protocol, and you could easily say, okay, great, Ari, they're going to be stable. Maybe that justifies a valuation lower than where they are today. But basically, I think the team's executing well. The phone announcement, I have no idea if that's meaningful. I think it does. To me, it suggested they're thinking about things the right way, which is consumer-focused, adoption-focused, long-term greedy. That phone is signaling to me we're focused on a 5-year plus plan, right? This is not about pumping our token over the next 2 months. We're investing for the 5 to 10-year plan, and I think that signaling matters. It matters to institutional investors, to devs, to builders, to the community, right? That this is, not only are they not dead, right? This is a time when people are asking, they're like kicking bodies in crypto, right? Which firms are not dead? And everyone's saying we're alive. And a lot of them are lying, right? And we know they're lying. And we know that there's a lot of insolvencies that are, skeletons in closets and just lost momentum, right? There's a lot of funds that are going to wind down over the next 2-3 years, not because they have to, but because they're 80% underwater. They just made a lot of money last year. Why stay open when you can't attract talent, and they don't have to, right? If they want to stay in the game, they can, and they can earn their way out and all that. My point, though, is that that's coming, and more insolvencies from exchanges are coming, and developers abandoning protocols is coming.
Yes.
Just, you have a protocol where the usage fell by 99%. You've got 9,000 daily active users. You're going to have fewer developers. You're going to have fewer people devoting their time and effort to trying to make something better that's a ghost town, right? There's so many social factors that are sprinkled in there as well, where, like, let's say the developer has already made life-changing money, and sprinkle in that the community is lambasting them every day and throwing rocks at them. It makes the incentive very, very small for builders to keep building unless they're super, just aligned vision-wise, which I would say the last year of bull market usually didn't attract that type of person. That the type of person was attracted likely 3 years ago, 4 years ago, 5 years ago. Totally. Absolutely. Ethereum, I'm trying to get an informed opinion on the merge in terms of, do I agree with the developers that it looks like it's going to go smoothly? I have no opinion at the moment. It does seem promising, at least. 2 months ago, I put it at 50-50, or frankly worse. I thought it was a third it would get delayed, a third it would launch on time and go very badly. And that was based on nothing. That was a guess. I wasn't putting that. I wasn't trying to flutter anything. That was just in my head. And now the latest info coming out of the Ethereum dev community and the test nets and all that it seems like they've gotten slashing working consistently. Things seem pretty robust. So I have no insight to offer your listeners, but if the merge goes roughly on time and smoothly, I think Ethereum's in a great position heading into next cycle, but not so strong a position that they won't face the same competition as usual from alt1s like Solana and like other newer entrants. So I think Ethereum's in a really healthy place, but I don't think we're going to see... Maybe you get a brief consolidation narrative for 6 to 12 months, for example, coming out of the merge. That wouldn't shock me. But if, for example, Ethereum was flying and every other alt layer 1 was like getting hammered in price, I'd be looking to buy the beaten up alt 1s because I don't think that's sustainable. There is fundamental value in some other ecosystems and many layers, including just tech innovation, and there's such incentive to like not stop fighting. So I don't think we're going to be in a like Ethereum is the smart contract platform next cycle any more than we were when we started this last bull cycle, right? Which we kind of started there. It was like all the 2017 ETH killers had died and it seemed like it was kind of ETH's room to run. And then, Ethereum faced the annoyances of both a new set of alt ones like Solana, as well as a few of the older ones doing some interesting things. So I don't think ETH is in the clear in a competitive sense, but I do think the biggest problem is Ethereum still doesn't have a scaling solution, right? So all of the layer 2 scaling solutions were deeply disappointing from my perspective, at least. Arbitrum, it's like this is the scaling solution and it launches and you're looking at $2 per transaction fees. Come on, that's the layer 2 scaling solution. And to use this, I have to go through a crazy convoluted bridge.
It takes 7 days to get the assets back down.
Yeah. And this is, first, no one who isn't crypto native is ever touching that and should never touch that. And so you're a crypto native person who deals with the delays and the UX and the extra risk of navigating with this, MetaMask interface, whatever. And then it's for $2 transaction fees, just terrible. And I'm not saying the project's bad or the team's bad. It's hard engineering. I'm the non-technical guy, but I respect how hard the engineering is. So this isn't meant as a criticism. It's just reality, which is there is still no scaling solution in sight for Ethereum. And a top performing token recently is Matic, partly for that reason that Matic is filling a critical role as a kind of sidechain scaling. I'm actually not sure. I'm ignorant of the current politics. I know there's some politics around, is it a layer 2 or a sidechain? I'm not trying to opine on that at all. Matic, in my view, is another high quality project, another team executing. So not trying to badmouth anyone here, but basically Matic, it's not an Ethereum scaling solution. It's an alternative solution, whether it's sidechain, whatever you want to call it. It's a separate set of security assumptions, and it's being used widely because there's basically no alternative today. All of that will eventually improve, but we're seeing how slow and disappointing a road it's been. If 2.5 years ago, 3 years ago, the idea that we'd have to wait another cycle for a simple layer 2 Ethereum scaling solution that lets me do an Ethereum transaction for less than $1, I would not have thought that would be a 4-year project.
Right, because I remember in 2017 they always went by different names. Once it was called Casper, then Shasper, then Serenity, then 2.0. We just always changed the name and move it down a couple of years. And since 2017, it's been 5 years now. And
the merge doesn't fix this.
Not yet,
sharding does not. Sharding may make a dent on scalability. It's not a solution. So we're still waiting on basically better Arbitrum or ZK roll-up chains, or and I'm frankly I'm not super in the loop on what the current hard problems are there and how much longer it'll be before we get an Arbitrum that with a 1 hour delay and a 2-cent transaction fee, for example.
So maybe there's a good opportunity that maybe we can take the gloves off and see. I'm currently reading a really interesting book called Dead Companies Walking, essentially. It's more from the equity world, but about, not just shorting companies, but essentially companies that kind of overstay their welcome. And usually when they're publicly traded, there is some liquidity where they can just keep operating for longer than they really should. Do you see any projects in the crypto space right now that you don't think will be here 3 years from now? And we can throw in the caveat so we're not offending the teams that unless they restructure and what they could change.
A few different angles to explore this question. One is the regulatory side. So I think this is becoming more consensus now, but I said this 9 months ago and everyone, I think it's not so much that people explicitly disagreed, but no one was preparing for this. No one internalized it, which is that this entire industry is bifurcating into basically AML KYC compliant and wildcat. So the regulators, basically what we've learned in crypto, we've learned a lesson that I'm betting will not continue, that it's kind of a false knowledge. We've learned that regulation doesn't matter. So the most successful companies in crypto were the ones that were blatantly illegal. in whether that's offshore exchanges, whether that's a tether, whether that's and when I use the term illegal, what I mean is violating regulation, not unethical, not a scam, not even necessarily criminal. That's a subtle difference, but there's a lot of regulations where if you violate them, it's a civil penalty. You're not risking jail time.
I mean, Block One is a simple case where they got slapped. They raised $4 billion. They got slapped on the wrist. I think it was like $27 million in fee, but like $27 million penalty for raising $4 billion makes financial sense to break the rules, which essentially that's what the crypto industry has been taught.
Yeah, and this is true of almost every crypto firm and company. Going back to Coinbase, I mean, Coinbase was violating a lot of regulations in its first 4 years. Listing of unregistered securities, custodying securities without a custodial license. And a lot of this is not just understandable, it's laudable. So to be clear, this is not a criticism. In 2016, you basically had 0 regulated custodians, partly because the SEC kept refusing to approve regulatory license submissions. So like one company I'm somewhat familiar with is Anchor Labs, Anchorage, the custodian, and we just disclosure, we were investors in their Series A. So for like a year, they were operating under a North Dakota trust, and the SEC had said, basically, we don't view that as legal, even though the federal government said it was. It was kind of a fight between two different regulatory bodies, which happens quite commonly, by the way. And Anchor had applied for an SEC custodial license, and the SEC was just sitting on it. I think they sat on it for like 2 years before finally approving it. So the entrepreneurs like Anchor and or the entrepreneurs building these companies like Coinbase, they acted, basically, they were providing critical services and infrastructure while regulators were getting their act together to approve the licensing that was needed and appropriate. So it's not a criticism, but the point is that that was almost everything in the industry. Every big company, almost every piece of infrastructure was in at least a regulatory gray area or worse. What's changing is Europe is very serious about travel rule that is getting implemented. I think it will start getting enforced within 12 to 24 months. Travel rule, for those people who aren't familiar, basically every single transaction that happens has to include identifying information on both sides of the transaction. There are exemptions for like very small dollar amounts, but it's whatever it ends up, maybe it'll end up being only for transfers over $10,000 or things like that. So I don't want to say it's every single transaction, but in much of Europe, if you're trying to, for example, withdraw $15,000 from Coinbase in a year, you will almost certainly have to provide AML KYC info on the wallet that you're trying to withdraw to. And if it isn't you, you'll have to get that from the third party. If it is you, they'll probably ask for some evidence it's your wallet that you control. I don't know if they've figured out how they're going to do that yet. It might be as dumb as a screenshot that like showing it's your MetaMask wallet. Maybe it'll be signing a message or something. But that stuff is basically, the European regulators are serious. I think they're going to start enforcing it. In the US, it's less clear how this plays out, but for people listening, part of the reason the SEC has brought so few cases is because they keep losing most of them. So the majority of the cases the SEC has brought in crypto that basically where the counterparty didn't agree to settle, the SEC either lost or is in limbo on most of them. So you have the Ripple case, right? 7-year unregistered security sale, extremely blatant, letter of the law, there's no question. Ripple is guilty, and it's as black and white as you can get, basically, and frankly pretty egregious, and there's massive customer losses, including ones generated from sales by the team just a year or two ago. And the SEC is on defense. Ripple is countersuing them. Ripple is accusing them of corruption. Ripple is demanding documentation internal to the SEC to make them look bad, and judges are approving it because there is enough there that bolsters Ripple's case that the judges are saying Ripple has a right to that information. So the point is, the SEC is really struggling because they're going up against extremely well-funded legal teams, and they're facing jury nullification. So one problem is, there was one case, Hashlets. The SEC sued a mining company that scammed people, outright scam.
Wow.
People deposited money to buy miners, and that same company sold a contract called a hashlet contract that was a forward right to the rewards mined. There's no question a hashlet is a security. Like the letter of the law, it's extremely clear it's a security, and it was marketed as security. Everything about this. And the company were outright criminal thieves who basically stole from the investors, and a jury still found them innocent because they said, hey, SEC, we don't think hashlets are securities. So the nightmare for any regulator is jury nullification, where the jury basically says, we don't recognize your authority as a regulator. Mm-hmm. And that's horrible, because as a regulator, you're like, do I still have a job? Like Gary Gensler loses a case like that, and it's like, a jury just told me basically I don't have a job. Mm. It's horrible precedent. It's huge egg on his face. It's huge egg on the face of the SEC as an office. And so the SEC has not been super eager to bring cases. But the DOJ and the CFTC, I think, are going to start picking up, and the SEC may or may not. But even if they don't, the DOJ can take down if they want. That's the Department of Justice. Yep. Those guys are so much more serious. Serious in the sense of scary. Mm-hmm. Like, people get a letter from the SEC, and they're like, okay, I've seen what Ripple did. I've seen all these people fight the SEC publicly, and in many cases win. The DOJ just shuts you down. Yeah. And throws you in jail.
Right. I remember like BitMEX, they got like one of the guys got pulled out of the New York office, put in jail. Like it's more intense. You actually get arrested.
And the reason is the DOJ, basically the SEC's powers come from Congress under the mandate of protecting retail investors. Mm-hmm. And so at the end of the day, everything the SEC wants to do has to be enforced by a judge who's basically a public civil judge. And the SEC makes the case that this entrepreneur was hurting investors. Mm-hmm. And then the entrepreneur's lawyers say, no, we weren't. And so, for example, I'll use Arthur Hayes as a case study. So Arthur, I forget, there was a public plea deal. I don't know if it's finalized. Is it finalized? What is he? He's going to spend like
he's in. I think he's in Miami. He's got like no. I think he's just house arrest.
Oh, house arrest. I'm sorry. You're right. House arrest. So I don't think that's necessarily the end of this for him. I believe other regulatory bodies like may come after him for more. But if you think about like the indictment on Arthur was a list of like, what was it, 28 felonies? Mm-hmm. It was a crazy laundry list. And as far as I know, he's not really contesting any of them. Mm-hmm. Maybe in a legalistic sense, but for the most part, he basically. They kind of have him dead to rights. But the reason why we're talking house arrest and not 20 years in jail is you think about his lawyers negotiating with the government. Here's a charismatic, winsome black entrepreneur who basically made money for everyone around him. His customers love him. At least this was true kind of 6 months ago. Yeah. Vast majority of people on BitMEX made money and are happy and were happy customers. Investors in BitMEX made money. Employees were happy. Basically, everyone was happy. Who's the victim? And so his lawyers tell the government, you put this guy on the stand and you say this is an entrepreneur who deserves jail. Mm-hmm. And we're going to say this is an American success story. This is a guy who, and I brought up his race just because this does play a little bit with the jury.
Sure.
Where, here's a modern success story. This guy's a self-made billionaire, and he did it by building a platform and a product that customers loved. He didn't screw anyone. He didn't steal from anyone. Where's the losses? Where's the harm? Who got hurt by this? This is government overreach. Very different when there's big losses. So like one thing I said last year was the regulators are going to wait for the losses. Yes. That's when they bring the cases, because that's when they have a much, much easier case to win. So you look at something like a Celsius, a BlockFi, a Voyager, all of those are facing many, many, many serious investigations from state AGs about, so it looks like plausible that no customer deposits will be lost for BlockFi. They still violated a crazy laundry list of financial regulations and laws, and they're facing subpoenas and inquiries from many states over that, like violating state by state licensing around misrepresenting something as a savings account.
Sure.
But all those cases, like BlockFi's in so much better shape. If no customer loses, they're just in a much better position, right? It's like, sure, maybe they're much more likely to pay a fine versus jail time,
correct,
right? Whereas if you have customers who lost their life savings, you have people who are going to testify to a jury that their life was ruined, they can't send their kid to school, their wife died of unpaid medical expenses because they lost their life savings. Those are the people who go to jail, right? The people where the prosecution can, put people in front of the jury whose lives were ruined by this person's behavior. And that's coming, basically. So, okay, sorry.
So to reel it back to the question.
Sorry.
That company's walking. What are some projects or companies, whether it's decentralized projects or centralized, doesn't matter. But like, let's say in the next 3 or 4 years, let's just say in this.
Sorry, that was a really long rambling. Okay, so the point of all of that is this industry is bifurcating over the next year or two. And I think what it looks like at the end of that is most companies are going to have to pick sides, meaning either you can be an offshore company and a small, you're a 4-person firm, you're all based in whatever, Singapore, Cayman Islands, and you're under the radar, and maybe you have a few US customers, but you're probably not getting subpoenaed. You're probably not, you're just kind of under the radar. And then you're going to have the big regulated institutional firms, and they're going to have to clean up. They're going to have to stop even, the Coinbases. There's so many things they won't be able to keep doing that are outrageous for $1 billion company to have been doing even a year ago around, they're facing I believe a class action lawsuit for over front running, right? They very clearly have had insiders front run like every new listing.
Oh, right, listings,
and you can't, you can't throw your hands up and say, oh, we tried. That's not legal. It's a crime. You are legally obligated to run a sufficiently professional operation that doesn't happen. And if it keeps happening, you either get shut down or you potentially face jail time for it. You're not allowed to offer those services to the public if you can't do so responsibly. So I would have, if we had this discussion 2 years ago, I would have said, I don't think they get in trouble in the next 2 years. Regulators aren't there. If basically all these, and I think everything I'm saying, my guess is Brian Armstrong would mostly agree with what I just said, maybe not in quite the way I framed it, but I think he would mostly agree and say, yeah, and we as a firm are maturing with the industry, which is a totally reasonable answer, by the way. Coinbase couldn't have been what they need to be next year. They couldn't have been 5 years ago, right? The same way, Felix, you and I, in our first day starting our firms, couldn't have been where we are today and where we need to be in 5-10 years to be successful. So, it's totally reasonable. Everyone needs to evolve. But so we're going to get the strict bifurcation. I think there's a lot of firms in the middle that won't exist. I would go so far as to say, I would probably say 80% of crypto companies probably don't exist in 3 to 5 years. I think this is going to be the sharpest changing of the guard that we've ever had in crypto, because the dollar costs to operating a company have skyrocketed. Basically, you could have survived the 2014 bear market with 0 expenses. If you were a Shapeshift, you were I love Eric Voorhees, by the way. I just think he's a really good actor in the ecosystem, OG of OGs. From Shapeshift in its first bear market, maybe he had a few employees, hardly any compliance costs, very simple operations. Now to survive a bear market, let me put it this way, just the regulatory inquiries, if you're a crypto fund that's done VC-style investing, you likely have a few SEC subpoenas on your plate about your portfolio companies. And just responding to those is hundreds of thousands of dollars in legal fees. And,
I've seen the operational cost of crypto funds itself go up tremendously the last few years. When we first started, an annual audit was maybe $15,000. Today it's north of $100,000. And so that also means that the new ones trying to start up, the barrier of entry is rising, and then of course also the cost of staying in business is rising, and that's not even getting to the more intense part that you just mentioned, which I've been seeing more and more often too. That even in cases I think, was it Luna related? It might have been Luna related, but again, VCs were also mentioned in the subpoena or in the court cases. So that's interesting.
I think we'll see a lot of tier 3 and tier 2 exchanges fail. We'll see a few higher quality professional ones act as liquidity shelling points to a greater degree than ever before, and most other players will just kind of fade away. I'm trying to think of other categories of companies that are likely to go under.
Protocols. I would assume there's anything there where there's a ubiquity. For example, there was no need for all the DEXs that sprung up. They're DEXs, NFT marketplaces, layer 1 protocols. There's just some stuff was very much copy and paste.
The tricky thing is just in crypto, basically, if you don't have a Luna-like negative flywheel, stuff usually never dies. But it can if you're talking about dApps, where you just end up with 0 users, especially dApps with a shelling point around liquidity, for example, where you're really not going to use that DEX with 3 people, right?
Yep.
Why would you? I would say that 99% of DeFi 2.0 does not exist in 3 years. 99% of NFT projects, those PFPs, you're going to have a few dozen that survive. That's probably that means probably 98% of them die. But what does dying mean? So the NFTs will still exist. There might, whoever the bag holders are, 1 or 2 of them will try to,
rally the troops,
keep a community going, create the pretense of activity,
Yeah.
and in some cases a little bit of real activity, genuinely trying to impart value. But
there's also this thing, unlike the last bear market 2017, we now also have DeFi, which means a lot of these tokens that would have never been listed on an exchange, they now do have some liquidity from normal people that provide liquidity, and like ultimately more and more of that. I mean, I watched, for example, the liquidity on Osmosis go down by like 90+%, beyond just market correlation, just like people saying, oh, the rewards aren't as big, let me pull out. And then so all of a sudden you can go from a token having $100 million in liquidity to having $1 million in liquidity. And as that last whoever's the last guy who starts pulling out, some of them will virtually evaporate, I think, in terms of like, and then and why does it matter? It's not just that there's a thin market. It also means, well, how do these companies, these projects keep funding themselves? Some of them are selling on the open market in order to, create more runway. And so that can turn into negative flywheel in itself, where for you to raise money from VCs, they're probably looking at, well, in the open market, it's trading at, let's say, a 50 million market cap. I would not invest in you at 100 million valuation. But then if they're selling in the open market, it only drives it lower. So it's, I think we saw some of that in 2019, but I don't think anywhere to the degree that we might be seeing it now, with most liquidity for small caps, mid caps sitting on DeFi.
I think a difference is that you had a lot of projects launch a product this last year very quickly. The whole DApp, DeFi 2.0 is just the simplest kind of category for that. So many dApps launched, and the problem, that's almost the worst point for a startup, where you launch a dApp. Actually, Chris Berniski did a great little half-page thought leadership essay on this 4 years ago, where the J curve. So, and he used Ethereum as an example at the time, where before a project launches, there's hopes and dreams, and the valuation can be anything, right? Yeah. Classic VC talk, it's, don't have $1 of revenue or $1. Yeah. The worst thing to do as a startup is have $1 of profits, because then people apply a multiple to that. Yeah. If you have no profits or negative profits, people are much likelier to ascribe basically an infinite multiple on that. Yeah. So the worst thing you can do is you launch your product and it then has zero, and it works, but it has zero traction, zero product market fit. Where do you go from there? That's the most destructive thing to a startup, because the team, right, where do you go from there? What are you hoping for? So I think most of those projects die, whereas the things that are more like a buggy alt one, you can keep hope for a very long time, right? Yeah. As long as there's people working on it and a little bit of money in the treasury, those things don't die.
I was going to say, because not all the innovation needs to root from the team. They can always keep recruiting new people to build on top, and then it keeps on living through the projects being built on it. For example, one of the chains that I don't think has a lot of value to it is let's say Harmony, for example. Harmony had a good time because DeFi Kingdoms, which now also is in the gutter, was built on it. But at the time, DeFi Kingdoms was bringing lots of traffic, $1 billion valuation, ergo Harmony's value. And so as long as these L1s can recruit new talent to build on them, they'll be fine. And as long as they have the $1 billion plus valuation, they should have no problem in incentivizing new builders.
Yeah, I mean, we see even, stuff like EOS is a good example, where still developers, still around, still trying some stuff. So, stuff like that, very hard for it to die.
Let me say something. What is something that everyone is worried about that doesn't bother you? And also what's something that no one worries about that worries you?
Man, the thing that's a good question. I worry about a lot. Not necessarily emotionally worry, but I think most of the things people worry about are deserving of worry. I worry less about hash power death spirals than at least the public pundits. I don't think that's been a crypto native concern in a long time, because we haven't had a threat of it for 4 years basically. But I think it's funny, there was a period where the Bitcoin maxis were making fun of me for saying a death spiral could happen at all. I think I made the best argument ever for why it's not a pressing concern, and that's the literal math. Basically, if Bitcoin fell to zero, the cost of mining 2015 blocks to get to the next difficulty adjustment is low enough that a single firm like Coinbase is incentivized to do it themselves. I don't have the numbers on me right now, so I don't want to throw out a number. But let's say it's $100 million or $200 million. Sure. It's completely rational in a pure self-interested, rational economic actor perspective to basically provide bridge financing to get to that next difficulty adjustment, so that you as Coinbase still have a business model, and so your billions in equity are still worth something. And of course, you're mining Bitcoin at the same time. So it's not if Bitcoin recovers. So the way I'd phrase that is, it's very similar to a bridge loan to a firm that's having a liquidity crisis but is fundamentally sound and profitable. meaning it's rational. It should happen. I think it would happen, and the dollar amounts are small enough that you don't even need to coordinate. A single firm like a Coinbase could and I think would do it. And we don't need Coinbase to do it. There's like any one of a dozen firms or a group of, frankly, like you and I, Felix, and 4 other people like us could pull together $100 million to save the industry. So, that's something I worried less about than at least some of the critics and pundits. What I worry much more about, and this is something that is not talked about and is not worried about anywhere near enough, is the fundamental security model of proof of work. And I think this is a much more pressing concern in bear markets, where the cost to acquire 51% hash power falls precipitously, because as the price of Bitcoin falls and more ASICs are uneconomic, they start getting offered at fire sale prices.
Super price, yeah.
So you can buy S9s today on fire sale because so many of them are not, viable. And so, basically it just gets much easier to acquire a sufficient hash power stake to take control of the network and mine empty blocks. Mm-hmm. Why would someone do that? They would do that because what happens to the price of Bitcoin if someone mines empty blocks for 2 weeks? It's going to fall. It's going to fall hard. And so if someone can establish a sufficiently large short position, it could be a rational attack. It's a very expensive attack. So this could be a whole hour-long conversation, but to do it like completely arm's length a year ago probably would have cost $20, $25, $30 billion, because you would have had to buy 51% ASICs. And could you even have done that? How would you have done that? You might have needed to build a new factory. It might have been a 2-year plan. But in a bear market, it's much cheaper because you can buy, on secondary sale, you could acquire entire public miners that are in distress. We may be about to have,
Compass has been in trouble, right?
There's a ton of public miners that may be about to go on fire sale as companies. Mm-hmm. And there's some world in which you may be able to acquire them basically at like below cost of their ASICs. So the ability to acquire hash power very cheap gets a lot easier. But even if it doesn't, even separate from the bear market, I'm concerned that at some point over the next 5 years, this attack is probably economically incentivized from an arm's length rational economic actor. And if so, it'll probably happen. And it's unclear what happens in response to that. So, and like people like Andreas Antonopoulos say, we'll just fork the attacker off the network. That has never made sense to me at all, in the sense that, like, are Bitcoiners really in real time during an attack going to form consensus on a new proof of work algo to fork to? And it's worth noting that new proof of work algo
can also be attacked.
Will be completely insecure, where it'll cost basically pennies to take over that new network. Yeah. And if we do that, and that's the response to this rational economic attack, which will win, in that scenario, the attacker makes money, then it's just a question of how long until Bitcoin gets attacked again in the same way and has to fork again. And so maybe there's an equilibrium there. Maybe there's a sustainable steady state where it's like we just expect that every 6 months Bitcoin gets attacked, gets shut down for a week, and we fork an attacker off the network. That's certainly not what any of us are hoping for Bitcoin to be. And I've yet to hear a plausible kind of counter argument, and I'm hunting for one. But everything here, when I say that, with what I just said, there's a million people who will throw out 3-sentence counter arguments. I've tried to dive into this pretty deeply with core developers, adversarial thinkers, and when I lay out the full logic of it, I was really hoping someone would be able to tell me why I'm an idiot, and so far no one has. So my hope in raising this, by the way, is not to FUD. I have a huge stake in Bitcoin personally through BlockTower. I very much want Bitcoin to succeed in every way, and I'm incentivized for it too. It's either I'm hoping people tell me I'm an idiot so I sleep easier, or if the answer is social coordination to thwart the attack, I'm very confident in saying that will only work with foreplanning. That will only work if things are ready and socialized and organized ahead of time. Because just imagine, you look at how many people Craig Wright fooled with his incredible amateurish kind of, scamming. If someone like an Elliott Capital, these guys are like Wall Street sharks, really smart, really long-term greedy. They'll bankrupt countries over a decade to win on CDS, on sovereign debt. If those guys did something like this and did a simple disinformation campaign, co-opt a few core devs, bribe a few thought leaders, the idea that in real time Bitcoiners are going to know which side is the attacker and which side is the legitimate, and are going to agree to a specific proof of work algo that benefits like one set of miners, no way that happens uncontentiously in real time. No way. We see how hard it is to even organize, like a core developer like Jeremy Rubin proposes the most modest Bitcoin improvement proposal, BIP, through the formal process, and that gets called an attack on Bitcoin and has like Twitter mobs up in arms. imagine if this was actually an attack done by sophisticated attackers. So my hope is that Bitcoin, and I'm not the guy to do this, but my hope was that Bitcoin leaders, people like Antonopoulos, Adam Back, people who are respected among Bitcoiners would lead, and frankly, maybe this is happening without my knowledge. I doubt it, because I've talked to too many people who would have to be lying with a really good poker face. But ideally, there's 10 of the biggest miners and exchanges and core devs have a plan and have it socialized among the 10 to 20 most important people to socialize it with, and they're just ready to break that out. But I don't think there is such a plan.
No, I like that a lot, because I've been thinking about that a lot myself, and like you said, it's easy to go down an hour-long journey on that one, just because I write dystopian fiction, and in that future they used digital assets, and I was thinking, how could you take a monetary system down? And there are game theoretical ways to do that. Of course, again, it takes massive amounts of money, but those massive amounts of money become more accessible in a bear market. When it's not 20 billion, it might be 5 or whatever it is, and then there's many players actually that could do that. Even individuals, like if Elon thought about buying Twitter for 44, well, that's not that much. The only question is what's the incentive for them? Where I think proof of stake, funny enough, is actually somewhat safer, because the money you're putting in, to acquire 51% will be virtually valueless, worthless after your attack. Unlike with proof of work, you can short BTC and still have the miner, to do the takeover and profit off the collapse itself too. But for you to attack a proof of stake system, you got to own 51% of the supply, which the pure process of acquiring that sort of stake, unless you game it with flash loans and other kind of social engineering, would become very, very expensive to do so.
Yeah, so I think the first order analysis, oversimplifying, is, let's say Bitcoin and Ethereum were both billion-dollar networks, let's say trillion. Yeah. And Ethereum's migrated to proof of stake. So the cost of being able to censor the Bitcoin network would be something like $20 or $30 billion of hash power. The cost of, first order simple analysis to do that with Ethereum, with proof of stake networks, you're looking at a third or half the coins, and that means you're looking at 333 billion or 500 billion to start. And of course, acquiring that stake, you're going to have to push the price up astronomically, if it's even possible at all. Yeah. So you're looking at a $30 billion cost to control the network versus a 333 billion floor. And really, if you wanted to acquire a third of all Ethereum, you'd be pushing the price up multiples of that. But where that logic does absolutely fall far short, as you said, is the critics of proof of stake will correctly point out you don't need to buy the Ethereum to control it. So if Coinbase is custodying 40% of all Ethereum, then a single bad actor at Coinbase potentially could vote maliciously with that custody of Ethereum. A single hacker of a single custodian could potentially gain control of a third of the network. And if you gain control of a third of Bitcoin, you can't really do anything with it, at least not directly. So that's the argument against proof of stake, that it's not about ownership, it's about control, and it may be easier to gain control of a third of Ethereum than 51% of Bitcoin hash power. I would retort to that the same problem with Coinbase custody applies to Bitcoin mining, which is you have mining pools that can be hacked and coerced and bribed. You have miners that can be similarly, same issue. And it's not necessarily more then you get into not decentralization, but distribution question. How concentrated is ETH custody versus hash power? Then you start talking about ASIC manufacturing plants and factories. So I think the biggest point of concentration risk for Bitcoin is ASIC manufacturing. That 2.5 years ago was basically a monopoly. Bitmain single-handedly controlled that market. Bitmain represented more than 50% of all ASIC manufacturing, and they were caught in, I believe it was 2019, putting kind of a backdoor in their ASICs that only got discovered 6 months later with forensics. Basically, hardware-level backdoors are almost undetectable. You basically need to look at the electronics under a microscope extremely carefully. And what experts tell me is there's hardly anyone in the world equipped to do it. It takes immense amount of time, and even then it's not foolproof. And Bitmain, what they said publicly was it was like a partial backdoor that they never finished putting in, and the reason they were going to put it in was so they could brick ASICs that had been, say, stolen from their warehouse remotely. But the point is, they could have, and maybe have, put in the remote ability to brick or take control of your ASIC, and you wouldn't know if they had. And there was a point in time not that long ago, 2.5 years ago, when the majority of ASICs in the world came out of a single Bitmain factory.
Yeah.
Today, it's not a monopoly; it's an oligopoly. There's a few factories now, but it's still a terrible risk. And if there's basically one malicious insider in 2 of those factories, there could be a backdoor in basically every ASIC on the planet.
Right, and it's worth mentioning that like a lot of these firms sometimes are highly political. Where Bitmain was heavily on the side of Bitcoin Cash, with Roger, and I think there was one more. And there was a whole hash wars going on at that time, especially as SV came to, where those two started forking out. So if they had a backdoor, they could literally reroute where their miners are mining. That too is an attack vector. You've been super crazy with your time. I got 4 more quick questions regarding more like trading and life, and then I'll let you off. I remember reading a tweet from you, and I might totally misquote it, but this was, I think, at least it popped in my brain during the last drawdown in May of last year, where he said something like, in the life of every trader, there will come a day when you'll find yourself curled up under your desk, and it's so funny because that tweet somehow was stored in my mind, and I saw one of my analysts literally lying on the floor, curled up in a ball, and I knew like, okay, this might be the time to long. And so my question with you is like, with all this chaos going around, like in the last few years when we managed funds, we've had things going like, Ukraine, COVID, Fed going crazy on the money printer to Fed, going into an aggressive QT. With so many, it almost feels like navigating a field of landmines. How do you find clarity in chaos as an asset manager and trader?
Zooming out, so a really big picture historical context. There's very little in crypto that has surprised me, and I don't think that's because I'm particularly smart and obviously I'm non-technical. It's really just analogizing to, tech markets going back to the 1850s railroads and even earlier. Basically just looking at how markets behave, how consumer psychology, investor psychology, going back kind of hundreds of years. I'm a geek armchair historian, market historian, and I wouldn't even say I'm particularly good at that, or I wouldn't hold myself up as an expert on that, but just enough to be like, why would anyone be surprised at the kind of market action of a 2000 tech, bubble collapse? Like, so many people have talked about that pattern playing out in crypto repeatedly, the psychology playing out repeatedly. So, for people to be shocked at things losing 95% of their value, this year kind of surprises me. Or people will say like, oh my God, I can't believe Bitcoin fell 50%. It's like, how are you surprised by that? This thing falls 80% every few years. And yes, maybe it's secularly becoming less volatile, and maybe the next falls will be smaller. But to be shocked that this thing that basically falls 80% every few years, and in the interim has many 30 and 50% falls, did it again, it's kind of weird to me. Like being shocked at kind of repeated patterns, I guess. It's really just a time frame issue. It's someone shocked because they're looking at like a 6-month time window or 1 year, and they're not. Same with Wall Street with real estate, right? Wall Street was like shocked at 8 standard deviation CDO squared models failing. And it's like, because they were anchored to the last 30 years of data when all national real estate had been both uncorrelated and secularly uptrending. But it didn't take a genius to say, is that normal? Is that sustainable? Is that a trend that you can extrapolate forever? The idea that real estate just only goes up in a straight line? Or was that a result of government policies and subsidies and Fed money printing and basically this 40-year secular kind of bull trend in real estate? So I don't mean to suggest that the stuff's easy to time. It's not. So as a trader, it's one thing to say, I know Bitcoin collapsed 80%. It's another thing to try to be 100% long at the right time and then not be caught off guard. But I'd say like when in doubt, zoom out and try to draw analogies. There's obviously a lot that's new in crypto that's fundamentally innovative and interesting and disruptive. But markets and psychology haven't really changed over 300 years. We changed the structures and the products, but but at the end of the day, humans are humans. And if you study the patterns of psychology and marketing and even like the marketing side, the way crypto projects get marketed and sold, the way NFTs were turned into Veblen goods, like I feel like an alien with consumer goods because I guess I'm on camera now. This is how I dress, right? I'm not wearing a watch. Like when I wear a watch, it's a $20 Casio. And I like the reverse signaling of that, to be honest. I have an ego about it. I am bragging about having a $20 Casio. So it's not that I'm purely above all of this. I do care about it a little bit, and I do signal the way I want to. But So I've never been into branded goods. I've never liked the idea of like, advertising for polo on my shirt kind of thing. And so kind of coming into NFTs, I felt like kind of an alien who'd already studied them. And so I like wasn't surprised, but I missed the PFP craze. It didn't surprise me. I understood it, but I also didn't feel like I had any skill in picking which PFP themes. Like in hindsight, I should have bought a basket of CryptoPunks, and I actively considered doing that in March of 2020. And the reason I didn't is so stupid. I make fun of this logic when like pensions say it. I didn't because I didn't think I could buy enough to move the needle for us at the portfolio level. They were like $40,000 each. I'm like, what am I going to buy? Like 25 of them just to get $1 million bet on this? Doesn't even move the needle. Of course, if I had done that, it would have been a 30 or $50 million.
25, 50 million, yeah.
Yeah, so that was stupid of me. Bad logic and a little bit of laziness, frankly. It's a little bit of operational work to accumulate a basket of NFTs that I wasn't eager to do, frankly, at the time. That was like during COVID when everything was going crazy. But my point is, obviously there's new things with NFTs. The way it was marketed, sold, hyped, the way the market played out, I feel like I was just watching a mix of the luxury watch market plus like pink sheet stock shilling, like just kind of a hybrid of that, and like wasn't really surprised about almost anything. But again, not being surprised doesn't mean you necessarily make money off it the way you want to, but at the very least, it means you don't go broke on it.
Right. So yeah, I mean, history most definitely does repeat itself, and even for me, as an emerging manager, it's always been super helpful, like studying the past of financial markets, like, books that teach about the history of hedge funds, some of the biggest names in the world, whether it's a Soros or Tiger, like Soros, like in, I think 99, actually more Druckenmiller than Soros, they had to wind down temporarily for a couple of years because they shorted .com, right? And so it's like, I remember him saying in one of the books that, Priceline was trading at more than all the airlines combined. This is insane. They shorted Priceline, and of course it kept going. And so, like, that's kind of the same lesson. There's a lot of people that probably try to short crypto in, a crazy parabolic bull market. It doesn't matter how right you are. The market will still make you poor. And so it's important to kind of, if you ever think about shorting crypto, kind of like wait for the actual trend to break. And even then, you got to be careful. Are we still like in a bull market or not? And the irony is that, I think, for example, like long short, which is something we've been doing a little bit more of, is something that I think has historically done pretty incredibly in sideways and bear markets like 2018, 2019. But it's also the very same funds that did long short that blew up the moment the market turned around. I'm thinking like, Tetras, and there was a couple of others that were famous for, like, let's say, shorting ETH, long in Bitcoin. It's a 24/7 market. So on a more personal note, how do you prevent burnout, maintain clarity, and kind of like find balance, especially now that we're like 5-6 years into this?
I learned this the hard way. I had never burnt out in life ever, so I frankly didn't really, I almost wasn't thinking about it. And in crypto, the mix of 24/7 markets and frankly the entrepreneurial journey of building a firm simultaneously, I was burnt out by mid-2018, a mix of the franticness of the bull market followed by the pain of the bear. And I now gear a huge focus of mine is sustainability. In a personal sense, at a firm sense, I constantly tell my team we should be operating at 90% capacity steady state so that when things go crazy, we're well rested, we have our heads in the game. Basically, if we're exhausted when we go home on Wednesday at whatever, 7 p.m., and
7 p.m. Come on, Ari.
Hey, this is for listeners. I'll tell you, the honest reality at BlockTower is like we're generally in the office 9 to 5, just as a shelling point for communication and meetings and planning. But the reality is like I tell my team constantly, I don't care when you're in your seat. Like anyone on the investment side, like my team. If I'm up at 3 a.m. if the market's moving. We all have price alerts on our phone, and so we're actually not staffed as a 24/7 trading firm, and we never trade requiring a stop out ever.
Yeah.
We may have a stop in a trade in the sense that like okay, I'm buying 2% of AUM Bitcoin here, and I'm going to stop out if it goes $1,000. But if I miss the stop out because exchanges go down or we have tech issues or whatever, that's never an existential risk.
Sure.
And I'm choosing to run the portfolio that way because we're not properly manned for true 24/7. Frankly, relying on stops in crypto, it's
horrible.
starting to get viable. 2 years ago, I think you just couldn't because exchanges went down constantly.
And flash crashes, wicks, where it ends up costing you more than it saves you.
100%, 100%. Even now, I mean, like FTX has had great uptime, but would I bet my firm on that FTX won't turn off for a critical hour when the market's crashing and I'm therefore not able to stop out of levered longs? I wouldn't bet my firm on that. I wouldn't bet my LP's full capital on that. The answer for me, and this is a personal answer, is trading smaller size than I otherwise would, so that my emotions and my mental and the mental demands of it are a little bit more moderate. Yeah. That means I'm leaving money on the table sometimes, but it's like if I'm sitting in a big trade, I have no life outside of that trade. I'm talking about a big portfolio level trade.
I agree, yeah.
I can't do or think about anything else. I can't be building my firm. I can't be recruiting. I can't be researching. I don't have a personal life. I am monitoring that trade. And there's rare moments where that's appropriate. But those are very rare for me. 2017, I was doing those every day, basically. And, I was all in every moment, was, sleeping 3 hours a night kind of thing. And now I go the other direction. Now it's all about compounding long term. It's all about sustainability in every sense. I force my team to take vacations if they're looking burnout to me. And all the time I'll be like, when was the last time you took a vacation? Someone will be like 6 months ago. I'll be like, book something in the next 2-3 months.
God, someone's got to force me. It's been 5 years.
I feel this. Hey, this is the curse of the entrepreneur, right? It's So I've been working very hard to get personal leverage. I actually just hired an EPA, like a personal assistant. Yeah. As we build our firms, as every entrepreneur should, you're trying to fire yourself from every role. That's still a work in progress for me, but getting closer. I'd say I'm actually almost at a point where I could walk away from BlockTower for a month with my phone off and feel comfortable. Wow. That I have traders, PMs, head of operations, I basically have the right people in every role where me being there might not even help. Even in a crisis kind of thing. We're not there quite yet. So I haven't had a real vacation in 5 years either. I have taken a few vacations, but it's always been with my phone, there and ready to command and control, whether it's a portfolio emergency or a firm. But I'm working very hard to get to the point. I desperately need a true vacation where I can turn my brain off and not be worrying about, if something goes wrong, I know I've got people smarter than me to make the right decision.
One day we'll have pina coladas on the beach. Because you said, you're trading a smaller size and, that lets you sleep better. I always know myself, like when I'm awake at night thinking of a trade, it's likely too existential and I need to down the size, or if there's lever involved, cut the lever. But how do you risk manage in crypto? We just talked about stops a second ago. Risk, flash crashes, you get wicked out and then it's back up to it worse. Shorts, of course, in the bull market, even the dumbest stuff can 10x. Puts, pretty expensive to do recurringly. And then cash, of course, sure, it's probably maybe the lowest hanging fruit but option that kind of works. Just keeping some cash on sidelines. How do you view risk management in crypto?
I keep it quite simple, and I frankly do this for BlockTower myself in practice, which is, usually risk management means cash for us. That's not to say we won't do a pairs trade or buy puts if they're cheap. I'm always looking for cheap hedges, but generally in crypto, all of the hedges come with new risks. Yeah. So, for example, would I buy the 6,000 strike Bitcoin put on Deribit? So what that would mean is, in the scenario where that put pays out, where say Bitcoin's at $1,000, am I confident Deribit will still exist to pay me out? Yeah. And let me be clear, Deribit, I have only positive things to say about the firm. That is not me suggesting they're in any kind of financial trouble, to be clear. Yeah. It's just a high-level heuristic that basically, like Bitcoin to $1,000, vast majority of the firm is insolvent and goes away and is basically dead. And the counterparty, it's just the counterparty risk is very high in that scenario. And my default would be that basically any specific counterparty in crypto probably doesn't exist after that day. And so buying $6,000 puts on Deribit just kind of doesn't make sense to me. I would probably buy a few if vol was really, really cheap, but I wouldn't think of those as a portfolio level hedge because it's too likely that in the scenario those win, you're not getting paid out. The simple reality is when we're scared, when we're in doubt, we are going to cash, and that cash is getting pulled from exchanges, and we're pulling from every counterpart. I mean, like during the Luna Week debacle, we basically pulled everything from every counterparty in every form, with some small exceptions. We had some trading capital on exchanges, but we were basically like, if everything dies in the next week, like we're only going to lose 5 or 10% of our capital, kind of thing. I think here's how I'd frame it most basically. Don't take risks you're not getting paid to take. And if you're taking risks, take it consciously because you're getting paid well to take that risk right then. I don't mean that it's a trade for 10 seconds. It could be that, for example, we'll sometimes invest in a small cap that is really hard to self-custody. Like maybe it's not supported by hardware wallets. It's not supported by Fireblocks. Basically, your only option is either leaving it on a random weird exchange or something like a desktop wallet, which are fundamentally insecure. So in a scenario like that, sometimes, for example, we'll leave it on the exchange where we bought it because there's kind of no great alternative, and we're talking about like a pretty small percentage of our portfolio. And so whenever we're doing something like that, I'm saying, I know I'm taking this extra layer of risk. I'm taking counterparty risk I don't want to take. Am I getting paid enough for that? And so a reason to do it would be, I think this small cap is going to outperform every other small cap we can find by 100% over the next 6 months. And so I'm taking a 20% risk or 10% or 5% of losing these tokens because this exchange goes under, but it's worth it to me. So it's, yet to me, risk management as a separate concept has never made sense. This is kind of weird to say. I have the title of risk manager and portfolio manager at UChicago. I have a lot of like risk management like credentials. I don't believe in, I'll go this far, I don't believe in risk management as a concept in isolation. Risk management is inseparable from investing and trading. And I think firms that try to firmly separate the two get into trouble. So this is a point where I've argued with some of our investors, and I stand very firm because this is a very well-informed opinion. I mean, someone can say I'm wrong, but I've spent a decent chunk of my professional career thinking about this, diving into it, practicing it, which is that the risks that tend to kill people. You think about Wall Street with the 2007 real estate collapse. Armies of PhD quant risk managers gave you the exact wrong answer, which was that these CDO squared structures are perfectly hedged. Or in some cases, people even bought CDS against them, or they bought derivatives against them. There was one famous TradFi hedge fund manager who thought he hedged his portfolio with a double short real estate ETF. And he lost money on the short because the double short ETFs actually lost money in 2008 because they're terrible products. They basically are guaranteed to go to zero over time for complex reasons.
Right.
And
so essentially, like they
yeah.
always buy high, sell low, but just the rebalancing process.
It's a rebalancing effect. So if you have excess short-term volatility, they trend towards zero, and most assets in a down market have excess volatility. So it's not guaranteed they'll go to zero, but it's a good baseline assumption. So my point is that I think the concept of risk management, except in its absolute simplest form, which is what risks are you exposed to? Literally, what exposure? So if I have $10 million worth of assets on FTX, I'm taking $10 million of counterparty risk to FTX. That's not rocket science. Almost anything more complex is indistinguishable from investment analysis. Assessing the counterparty risk is credit analysis. It's basically credit investing. Assessing smart contract risk. So like the work you have to do to risk manage DeFi yield farming is inseparable from the work of being a VC in DeFi, which is you have to evaluate the smart contracts. You have to evaluate the game theory flaws. You have to evaluate the quality and professionalism and ethics of the team. All of that work is inseparable from risk managing a DeFi yield farming position. And where people get into trouble is when they try to treat risk management as a separate discipline and they fall back on like stupid, simple statistics like VAR. Like VAR, like VAR is a fine concept as one little piece of a dashboard. But to manage to VAR, let me put it this way, any investor, fund, firm, whatever, that said they manage risk to a VAR limit, I would never personally invest. I would assume either you fundamentally have no idea what you're doing as an investor, or you've structured your firm in risk management to appease idiot investors, to tell them what they want to hear. And my concern would be that you're managing risk to what investors are telling you they want,
which is actually managing it.
Versus actually managing it. And the problem with that superficial version is what Wall Street learned in 2008. It's not hypothetical. It's you will blow up. I'll name them. I had a public debate with BlockFi like 2.5 years ago that was a friendly debate and superficial. This wasn't super long. It was, 5 tweets back and forth. And they basically were saying they have really good risk management, and they didn't like go open kimono publicly on Twitter, but there was a little bit there, and I had a call with them and we went a little bit more into it, and they were kind of managing it in that kind of frankly normal Wall Street way of kind of a stat arb, like what is the price of GBTC? What is its correlation to Bitcoin over the last 2 years? Well, the problem is if you ask that question prior to the start of 2021, it was basically zero, and GBTC had never, ever gone negative. So any quant, any data, any statistic metric you used said the risk of GBTC going negative was 0 because it had never happened. That was obviously nonsensical. Anyone who's ever looked at basically products like GBTC constantly go negative in TradFi. There's hundreds of products like that. It's not even liquidity. So REITs, which are kind of real estate versions of GBTC, they trade negative when they're closed-end funds whenever real estate falls out of favor, which is every 5 to 10 years. So very commonly they trade at 10, 20, 30% discounts. Nothing went wrong. It's just...
Right. Well, when I say liquidity, I mean more so like the inability to redeem. Because if you could redeem on NAV, then this problem wouldn't exist. But whether it's GBTC or staked ETH, kind of like similar issue where value goes in but value can't go out. So then it becomes a market of its own that is not really tied. Like technically it's tied, but not really.
You're 100% right, of course. So the redeemability of an ETF means that it's arbitrageable daily, which means that it will trade in line with its underlying at the end of every day. And the problem with GBTC is there's no arbitrage possible. There's nothing that forces it to converge to its fair value ever, at all, period. So we have to hope that either their lawsuit on the SEC works and they convert to ETF, or maybe we have to hope that Grayscale voluntarily allows redemptions under Reg M, which they probably have no economic incentive to do. They're probably strongly incentivized not to. So basically, we're relying on the good graces of Grayscale for this thing to ever forcibly converge. Otherwise, it's kind of like betting on the relationship between ETH and Bitcoin. Like, should they be correlated? Sure. GBTC should go up with Bitcoin and go down with Bitcoin, but it doesn't have to. It's not impossible that over a year, this isn't going to happen in a day. We're not going to have a day where Bitcoin's up 30% and GBTC is down 30%. But that kind of did happen over a few months where GBTC fell 30% during a period where Bitcoin was up. I don't know if GBTC actually lost value in absolute terms in that period, but it could have easily. You could have a period where Bitcoin's up 30% and GBTC's down.
Yeah, I remember that happened with ETH because ETH was trading at like 1,000% premium. And while I think there's like 2019, 2020, as Ethereum starts going back into the bull run, ETH premium goes from like 1,000 down to like maybe 130. And so anybody who had money in there, they thought like, what shouldn't I be making money? ETH is going up. Nope, it's actually going down because thousands line up to Arbit, and that's something that people usually don't check.
And the only way to risk manage that is first principles thinking, right? So you have the problem, you can't use data when you have something that is 2 years old. And if you are going to use data, make sure you're using the right data set. So the right data set was all ETNs. And anyone who correctly modeled GBTC would have said it's almost certainly going to go negative at some point. And then there was interesting work to do trying to time it. And I'll say I was off by a year. I was very confident it would go negative. I said that publicly, repeatedly. I thought it was going to go negative in the next bear market. I was very surprised that it went negative in, February or March, in the midst of a raging bull market, and the Bitcoin made new all-time highs after that. So often it's very hard to time the end of these kind of Ponzi-type dynamics, but anyone who was surprised that GBTC went negative, like, why? It means that you didn't spend 10 minutes thinking about it correctly. Correctly. If you thought about it correctly for 10 minutes, which is, this is an ETN, it's not arbitrageable, there's a lot of speculative money that went in trying to make money. What happens when that money tries to leave? Well, unless there's enough retail bidders to buy it all, this thing will go negative. And that, now that we've had such gigantic inflows into GBTC, that is kind of sowing the seeds for its own negative turn. The pattern in markets in general with a lot of this stuff is money comes into a good idea. It's not risky at that time, or not that risky. So doing a private placement into GBTC 3-4 years ago wasn't that risky because it wasn't a crowded trade. The simplest way to phrase it is a crowded trade. By the time, 2 months before it went negative, it was a super crowded trade, right? There were billions and billions of dollars that desperately needed to exit and wanted to exit. And so you were kind of picking up pennies in front of a steamroller at best.
I remember I was on the phone with Grayscale and also BlockTower, which facilitated a lot of the lending. It was maybe June or May of 2020. I think it was May 2020. At that time, it wasn't GBTC. It was more ETH that was still like very high. I think it was maybe 500, 600% premium, something along those lines. But I did ask them for, can you give me a spreadsheet of like, how many people have done this trade that are still locked up? And it was something to the point of 99% of shares were still locked. So I knew that, we're looking at a very small float that is currently, making this price. And then you have 100 times that hitting the market before I finally would get unlocked. So ergo, whatever premix is right now will not exist a year from now or 6 months from now.
Right. Right. We actually did an ETH trade, and we kind of got out just in time. It was at like a 14% premium when we got out. I'm not saying that it was a dumb trade. I'm saying it was a trade, and an obviously risky trade. Like when we did that trade, we're like, this is a risky trade. The premium could go negative. This is a trade. It's like it's a trade like any other, right? Like we're betting that our timing is good enough here, but in no way is this an arb or a carry trade. It's a risky speculative trade.
Yep.
End of story. And so very weird that, to kind of frame it as like we had sophisticated risk management and we were caught off by like a black swan. There was no black swan. And I would go so far as to call it, kind of intellectually dishonest to try to call it a black swan. Like at least like own it, take responsibility. You took customer deposits, stuck it, you tried to trade with it, you traded really badly and lost their money. That's it. That's what happened. I think that the excuse or the defense was we didn't understand what we were doing. Like we didn't understand the financial side. We weren't trying to rip anyone off. We weren't trying to commit any crimes. We weren't trying to unscrupulously gamble customer deposits while misleading them about the risk we were taking. We just didn't understand what we were doing. That's the kind of best case argument for them, I think. I don't mean to be too harsh. I don't think these are bad people, but like, you
when you get to the size,
deposits.
there's a certain level of responsibility comes. We're talking we're not 2014 anymore. It's billions of dollars. And
you're being entrusted. You're not just entrusted. You're marketing to retail, telling them this is a safe option for their life savings, and then risking their money on basically gambles where if the gamble pays off, you get to pocket the entire amount. The incentives are so perverse. It's such a scammy structure. I'm not saying it's a scam or the people are scam, but the structure is so scammy that to be anything less than a super scrupulous, ethical, careful fiduciary, I think they deserve to get lambasted. And I hope that kind of stuff, it will come back. There's demand for it. Everything I just talked about with real world lending, I wouldn't have tried to do anything in the crypto lending space 2 years ago because it was too crowded with this kind of nonsense. You couldn't compete. The problem was, if Celsius is going to offer 12% on deposits, kind of unscrupulously,
right.
and the best I can do to offer in an ethical form, where basically retail, like ultimately you can blame retail. Retail doesn't know or care about the riskiness. They're not asking smart questions. They're not holding the feet to the fire of these people. And so what that means is if you're a scrupulous platform, you can't compete because you just look like a bad version of Celsius to retail. Yep. And so, BlockFi is going to get the VC money. The BlockFi competitor that acted more scrupulously, they don't get the user growth. They don't get the VC money. They don't get the traction, and they just fold. I'm hoping that there was enough pain on this that there's now room at least for good, ethical, viable, sustainable business models to enter and compete. But I'm under no delusions. Next bull run, you're going to have more Celsius, Voyager, BlockFi kind of nonsense, gambling unethically.
People flock to the highest number.
Deposits. And yes, and to some degree, I don't know. I spend a lot of time trying to save kind of retail from simple mistakes like that are stupid mistakes in a financial sense, but of course, if someone's a doctor, they're not going to be a credit expert, and they're not going to spend 40 hours a week doing their own research on Celsius and Voyager, and that's reasonable, and they shouldn't have to, But I don't know. I'll keep trying to publicly educate, and next cycle, I'm sure I'm again going to be frustrated at the equivalent of Celsius shills telling me I'm just fudding, and I'm evil for warning them to trying to get them not lose their life savings. But
it is tricky. It's you never make friends being bearish in this space. Not even on a single asset. Like I was on a podcast recently, and I have my concerns with a lot of like the metaverse Gen 1 stuff, like Axie Sandbox, just like you do, and back holders don't take that well because they have their own vested interests, even though there's a lot of points to see why that some of these things won't work. Now, to wrap it up, one final question for you. How do you see markets evolving over the next 6, 12, 18 months? So kind of like, what's your outlook going forward, both the good, bad, and ugly? What are you excited about? What are you, of course, we're lending, what do you think is still ahead of us?
So my base case right now is, and I think this might be consensus almost among traders, is that we're probably right now in kind of a medium, I'll call it a medium-term counter-trend bounce. What I mean from that is we're still in a bear market structure in both TradFi and crypto. We could bounce as high as something like 33K in Bitcoin within that bear market structure. That would be a little bit like the 2019 kind of bull market.
Yeah.
I'm not saying it. I mean, that was crazy that we went all the way up to like 14K,
Yep.
and I'm not predicting anything like that. But point is, we could get a 3 to 6 month rally here that's still within the bear market structure. I think my base case is that it's shorter lived than that. That it's something like a 2 to 8 week rally here that I think has started. I say all that very low conviction and humbly. That's my current base case. By the time people hear this, Felix, you and I may have a different base case. So, if you're listening to this, I wouldn't trade on that basis. That's my view of the moment, but it might change. If macro is ugly, if we see equities sell off 20% from here, could absolutely see Bitcoin to 10 to 12K. If equities sell off 35%, 40%, my base case would be Bitcoin back to 6 to 8K. And that's really, I don't think I'm saying anything aggressive with that. That's almost just the correlation to macro and TradFi and equities, which my base case is that continues. At some point it may break. At some point we may see equities down 20% and Bitcoin rocketing. I certainly hope that happens, but I'll believe it when I see it. That has never happened in a sustained way in the past. That may happen in 5 years, it may happen in 10 years. I'm not going to bet that it's happening until it happens. That's been a widowmaker trade. This is the first time Bitcoin's going to ignore equities.
And you don't see a path where the Fed is going to ease up, especially with the dollar now having parity with the euro, and kind of the whole dollar wrecking ball theory probably causing a lot of damage to emerging markets.
Yeah, totally. So, I mean, could we just head to all-time highs in everything? It's possible.
I guess there's layers between, easing up on the QT versus going to all-time highs.
Yeah, but is it possible that the low is in crypto and TradFi? Yeah, I'm not saying it's not. That wouldn't be my base case, partly because, Bitcoin is basically 2 days of volatility away from testing its lows. So just in a random statistical sense, it's unlikely. But yeah, so if dollar reverses, so some of the inflationary prints are transitory. Anyone who's followed me, I've been kind of, I can't even say warning. I've been shilling inflation for 4 years publicly that we're headed into this. So I'm not an inflation skeptic at all, and I do think we're headed. We're in the secular path of currency depreciation. I fully believe all that. With that said, the most recent print, the reason the market didn't react more negatively to the 9.1% CPI print was because half of it was energy, and energy has already started reverting, and there is demand destruction. Basically, there are certain fundamental kind of responsive things that kill inflation, certain types. So, when energy prices skyrocket, people start driving less, they buy less gasoline. That's called demand destruction in economics. Same with certain foodstuffs, certain commodities. If palladium rockets and it's being used in catalytic converters, car manufacturers find other things to use instead of palladium, and there are other choices. So one possible bull thesis for both macro and crypto is inflation starts pulling back, the dollar starts weakening, we get competitive currency depreciation from from the U.S. Basically, the Fed feels a lot of pressure over the dollar strength, and with inflation moderating, that we get dovish Fed policy, and then that kind of the economy is just doing well and growing, and there's tech innovation happening and drug innovation happening and all that. And so we're kind of back in growth mode, and suddenly the thing people fear is fiat. So I think this change could happen very fast, where all of a sudden it's fiat is a hot potato, governments around the world are still printing it, all of those inflation, currency depreciation narratives take hold again, and fiat's a hot potato, and everyone starts buying equities and crypto and gold and all that stuff. I could see that happening. At the moment, it seems to me like TradFi macro is too weak for that. There's so many skeletons in the commercial real estate closet. There's still a lot. I'm not in the weeds on macro. I don't have the time to be. I don't have any real insight over Wall Street on that. With that said, there's definitely a lot that's not priced in very transparently. Like commercial real estate in particular, you have skyscrapers that are effectively trading at 99 cents on the dollar that are fundamentally impaired. That those skyscrapers are basically never going to be full again. Part of this is the shift to remote work, the secular shift. You couple that with the rising interest rates, and I think in commercial real estate, we're headed for something like the 2007 residential real estate collapse, and that is not at all priced in yet. There are pensions that are going to be rendered insolvent because of the commercial real estate crash that has not happened yet. How much of that is priced into other markets? So it's definitely not priced in commercial real estate. That's pretty visible. But that's also not, I'm not the only person who knows that. Like, the reason it's not priced in isn't because smart money doesn't know that. It's not priced in because it's like structural. You have a skyscraper, basically these are not mark-to-market assets, right? You have someone who owns a skyscraper, they're financing it with a bank. There's no markdown until something happens. It's kind of like VC books, right? Like, most VCs have basically not marked their books down yet. People don't realize that many of the top VCs, their portfolio is down 90% right now, right? Or they've marked down their books by like 20%. It's like, you couldn't sell this down 20%. You couldn't sell it down 50. You couldn't sell it down 80. Your book's down 90%, but it's going to take 3 years before people figure that out, because they're not going to mark those assets down until there's a material event that they forces them to. So you get this weird lag where like people know that this thing is really 50 cents on the dollar, but it's still marked at 95. Frankly, not that different from, you know, Luna, like 2 days into that crazy week when like everyone, you know, we all knew it was unraveling. And there's a lot of people who, you know, UST still trading at 90 cents on the dollar. And like, you and I know the jig's up, but a lot of the world doesn't. Like, we know it's probably going, like, not, I at least wasn't sure it was going to zero. Maybe it would get bailed out again.
And I got in arguments with people where they did the same thing we discussed earlier. They looked at historical data and said, oh, but it's gone to 93 before in last May, and it just bounced back. It's going to take like 7 days. Everything will be fine. I'm like, well, 2 years of historical data is not relevant here, especially when the background is completely different. You know, you had maybe like 1 billion in UST. Now you've got 18 billion in UST. And, you know, you were in a bull market, now you're in a bear market. So like there's, and so many more, you know, mechanisms to that. You know, the anchor yield reserve was running out, but interesting. So to dial it back to the question, 6 to 12 months. So you said base case for you is we are going to go lower, but you don't completely cut out the possibility that, you know, if the Fed changes their stance because the dollar's getting like, you know, too strong internationally, that, you know, people could shift back over into.
Yeah, so I'd say I'm not making any 3 or 6 month long beta bets right now. I don't know. So I laid out kind of a base case. I basically said anything could happen. Like honestly, what I said, if you deconstruct it, was my base case is we rally for the next 4 weeks to 2 months and then make new lows. But I said, you know, and then I made the argument that, well, maybe we just had to new all-time highs and the lows are in, and maybe we go to 6K Bitcoin. So I basically said nothing, you know, to be fair. And the reality is all of those seem plausible to me. I don't know. So kind of my current base case is what I laid out. That's kind of my current trading roadmap at the moment. So at the moment, basically, since we hit the 17.6 low a few weeks ago, I've been trying to very aggressively play things from the long side, but in a very disciplined way. So like that night, I got very long, and then I ended up like taking tiny profits on most of it. Like 3 days later, I'm like, okay, I'm not getting the V-shaped bounce I wanted. Things don't feel quite right. The way I expected this to play out in a specific way, it's not happening. Let me kind of, I think in that case, it was tiny profits. In another case, it was a tiny loss, you know, buying 21K for a breakout and then stopping out at 20K kind of thing. So I've kind of kept, and I think that's the right way to approach it when you get down to levels that deep that quickly. But so basically I'm trying to stay nimble. I'm kind of being a trader and trying to be nimble, but from here, playing it from the long side. Basically, my goal is to not get caught off sides too badly if we do get a move down from here to 12K.
Yeah.
Still win the game. I'm fine taking losses there, but I don't want to get blown up. And if we do get the move from here to 28K, I want to win as much as I can. So everything I've been doing for the last month is trying to thread that needle, right? How do I do that? And there's no simple answer. It's not like there's a derivative you can buy, so it's about trying to find smart trading setups, trying to buy vol when it's cheap, create option structures, but there's no magic bullet here. At the end of the day, it's if I add skill as a trader, then maybe I can do that. But it's not like there's an answer I can give for, and you know, as I just said, like I think I've misfired like 4 times on that and just kept stretching out basically. So that was my risk management on this. It was kind of like be very disciplined on the entry, and if you get a good entry as a trader, you usually get the chance to scratch out or take a small loss, even if you're wrong. That's the benefit of kind of, you know, being really disciplined on the entries.
Amazing. Well, Ari, it's been so great having you here. We'll definitely have to do this again, you know, maybe next year or whenever you have time. I know like it's crazy busy for both of us. But where can people find out more about you? What's the best way? I assume Twitter?
Yeah, Twitter is kind of the repository, and if I do an interview, I usually post it there.
Awesome. So I'll share it below so people can follow you there. And with that, thanks so much for being on, and we'll see you next time.
Thanks for having me, Felix. Maybe next time we'll have to. I guess this is kind of us trading chairs, because last time I interviewed you. Me. So maybe next time it'll be you in the hot seat again.
I would love that. Awesome. Thanks so much.